Good evening, everyone. On behalf of SB Gabhawalla and Company, we would like to welcome you all for today's lecture meeting. Today is 643rd day since GST has been implemented in our country. 643rd day. By far, we have one Amendment Act. Our CGST rules has been amended 31 times. We have 364 notifications, 224 circulars and orders. So in all, we have 620 amendments, circulars, and clarifications which are issued by the government. The 620 number which I just mentioned are pertaining only to CGST and IGST. If you consider SGST and compensation cess, then the number might just double up. So on an average, if you see that 643 days, 620 documents which have been released by the government. So on an average, we had one amendment or clarification which was issued by the government on daily basis. This is the good and simple tax which we are talking about, right? GST has been a roller coaster ride. The objective of today's meeting is to discuss some of these important amendments. The new returns which are proposed to be implemented from 1st July, will have a glimpse at those returns. We'll also try to understand the processes and methodologies which we need to adopt for GSTR 9, which is our annual return, and GSTR 9C, which is the audit report. And last but not the least, some important procedural aspects which we need to take care of while closing our books of accounts from GST's perspective. I would like to invite Mr. Gabhawalla to enlighten us on these aspects. Over to you, sir.
Thank you, Yash. It's always a pleasure to interact with all of you on a regular basis. And GST has given us a lot of opportunities to meet face-to-face. Of course, on a regular basis, we do keep on sending you updates and by emails and WhatsApp. But as Yash highlighted, there's really a deluge of changes. One notification or one amendment a day. And just if you look at the recent amendments in real estate, that document, you just talked about one document, but one document can run into 70, 80 pages with series of annexures, footnotes, explanatory notes, etc., etc. So I'm sure in deluge of changes like this, it's very likely that there could be some amendment which we might just skip up. And any mistakes and ignorance, and the first thing as a law student which we studied is, ignorance of law is no excuse. And of course, ignorance on the part of the lawmaker is always an excuse. You always see many retrospective amendments or clarificatory amendments just to overcome some drafting lapse. But if we forget to implement something, there's no excuse. There are penal consequences. There are huge interest burdens. And as time progresses, till now, in the 18-month journey, we've still not seen too much of investigation and a lot of painful things from the GST department. But of late, a few places things have started, arrests have started, and therefore it's important that we are on the right side of the law. And that's where we felt that maybe in a few months, we should do some outreach session like this, wherein we can touch upon what are the major changes. And we thought when there's a change of a financial year, I think that's the best time to do it because there are quite a few things which are associated with the change of the financial year. And in that sense, March 2019 return becomes very, very critical, both the GSTR 1 as well as the GSTR 3B. Immediately thereafter, we have the first financial year closure happening, which is in terms of the GSTR 9 and the 9C, the annual returns for 17-18 and the audit report therefore. Of course, we did a detailed session on the annual return and the audit report, but that has been since quite some time, and a lot of water has flown through thereafter. So maybe a quick rebrush of that may also be making a bit of sense. And finally, we can just end with the new written format as Yash was highlighting. It has been already there in the public domain, and the system is under development. They are proposing to bring it mandatorily from July 2019. We don't know whether it will be July 2019 or August or September. But definitely that's the way the government is moving towards, and therefore the day their GST system gets ready, they will expect you to do the new return format. And if your systems are not ready, then there are problems around that. So we'll just try to understand some basics. Maybe we'll not go into an elaborate session that will reserve for a future date. but at least understand some basics so that if you want to go back and talk to your IT teams, you can go back and at least start some basic discussion around that entire process. And finally, some do's and don'ts, quick recaps and do's and don'ts towards the end of the session. It's going to be a bit of a long session. Please bear with me because there are just too many things to cover. So we'll try to go as fast as possible. And of course, wherever we'll try to make it as relevant as possible. And that's the reason you will see that the outline which we have tried to bring is not in terms of sections or in terms of the amendments and notifications and things like that. But what we'll broadly do is we'll spend some time understanding what all things are important from a GST perspective, from your outward supply perspective, from your income perspective, which is basically your GSTR 1. And thereafter look at the inward supply perspective and what are the important issues to take care of. And there, of course, we'll divide it into two broad baskets, which is the reverse charge mechanism and the ITC, input tax credit, which is, of course, the heart of your entire GST provisions. And then we'll go to the other aspects as and when time progresses on these aspects. So let's start quickly with the first aspect, which is the determination of the outward supplies. And by far, because the URD RCM has got a sort of a burial, of course, a small ghost came back in terms of real estate just a few days back, but that's impacting a small pocket of this entire audience. So that we'll park it separately. But otherwise, because URD RCM is no longer effective in general, outward supplies is the most important aspect of your tax compliances. And then, of course, in the ITC side, you have your reconciliations and things like that. And therefore, we'll spend some time understanding whether our compliances on the outward supplies, the disclosures, the tax calculations and all of them are correct or not, or are we missing out on some of the developments which are the recent developments on this front. As far as outward supplies are concerned, even from an audit and an annual return perspective, the calculations of your outward supplies in terms of value will have to find a source into some document or some, the financials. So typically in your financials, you'll start with your profit and loss account. Typically, your sales and other income schedule, which is basically all your GLs relating to sales, are things which will definitely be a part of your liability towards GST, subject to the tax rates and exemptions. Over and above that, you will find that there are various expense heads where there are entries on the credit side. And this is something which many times companies miss out. There are various types of recoveries which are being carried out either from the vendors or from customers, but debited to the credited to the expense account rather than taking it into the sales account. So a credit in expense is also something which should be seen with a scanner. It's not only the sales schedule, not only the other income schedule, but also a credit entry in the expense account is something which you should look at and see whether there is some source of an outward supply, some source of a taxable activity. A very common example, which many a times comes is in a case of companies. If you have 5-6 group companies, and one of the companies incurs a cost for all the 5-6 group companies, based on some cost sharing ratio, the cost is credited to the expense account itself. So for example, one company pays the rent for the entire premises, and then 1/5 rent is debited to each of the 4 group companies. And for that, you credit the rent account only, you do not take it to the sales account. Now, necessarily, as far as GST is concerned, the GST law will say this is a supply which the parent company is making to the other company in terms of infrastructural support or a subletting of the premises. Now, necessarily, this goes into your rent account on the credit side, and therefore, you need to find it out and make sure that you are adequately discharging taxes on these types of transactions. So, this is just an indicator that there can be something which is in the nature of a credit item in your P&L account, reduction in expenses, which can trigger some GST liability. When you go to the balance sheet side, a very common thing which you have to look at definitely is your fixed asset schedule. You'll have sales, disposals, and retirements from your fixed asset schedule. Many of them would be liable for GST. There are specific schemes, especially in case of motor cars, which we also will be talking about. And of course, the entire thing has to be looked at with a scanner, and accordingly, tax has to be paid on that. When you're looking at the sale of fixed asset, we also need to understand our accounting treatment for buybacks. Many a times, what happens is you sell an asset, and in return, you buy an upgraded asset, and you typically have what is known as a buyback scheme. Many a times, we've seen companies that in case of a buyback transaction, they account for the transaction in the books of accounts at the net value. So if, let's say, I'm exchanging my old computer and buying a new computer, and I get, let's say, 20,000 I pay for the new computer, and the old computer has a value of 5,000. Otherwise, I would have paid 25,000, but because it's under a buyback offer, I give the old computer and I pay 20,000. Now, many companies account straight away 20,000 in their asset schedule, which is not correct. what you need to do is you need to take 25,000 to your asset schedule, and 5,000 is a sale of an old asset. And that sale of an old asset necessarily will have a GST implication. Now, if that has not been done, this is something which one will have to look at with a scanner. And of course, again, this is something which is more an wrong accounting treatment. But that wrong accounting treatment will necessarily have an implication in terms of GST liability as well. That takes me to the next point, which is reimbursement claims. Especially when you're looking in the logistics sector or something like that, you have lots of examples of reimbursements being claimed. Many times we take that interpretation that you are a pure agent. If you are a pure agent, then it goes outside the scope of valuation. Otherwise, you are required to pay GST on that. And typically, you can also have examples like property tax, which goes in your balance sheet as a inclusion and an exclusion, but GST might be payable on that. So all those reimbursement claims, again, the source might come from the balance sheet. This definitely comes from your P&L and balance sheet. But the challenge which GST brings is Schedule 1, which we have kept on talking again and again, wherein there are various examples of deemed supplies. And one common example is the example wherein you are told that any branch transfer of goods or services to your own branches in different states, even if there's no consideration, will be treated as a supply and you are required to pay a tax on it. We have implemented it across organizations during the implementation phase. We have a detailed slide where also we will talk once again a little bit about it. But yes, this is a figure which typically will not be easily evident from your financials. And therefore, even as tax practitioners, even as the tax managers in your teams, you might need to prod a bit deeper. Many a times we have seen that whenever you talk to the clients and clients, tax managers or accountants, they may not be even aware that there is a possibility like this. A very common example, which many places we find people are taken by surprise, is brand usage. You might see a scenario that a company has a brand or a logo. That logo is used by a group of companies. And now under Schedule 1, we are told that this is a deemed supply. And therefore, there has to be some charge levied by the brand owning company to the respective individual companies. Now, these types of transactions, some employees who are working commonly for across various companies. And there's already one advanced ruling which we'll be talking about in the next slide. So all of those examples may not be easily visible in your balance sheet or in your P&L or in your accounting entries. One will have to really ask pertinent questions and find these types of entries so that one can then take a call on whether this needs to be reported, what is the valuation, and what are the related risks and the tax liability along with credit. Make no mistake, in many of these examples, because credits are fully available, it's more a paperwork. It's more a compliance rather than a real tax cost. But not doing it today, and then after 3 years, finding a GST officer to find it out for you and having no defense is all the more complicated. And therefore, it's always better to be safe rather than sorry at a later point of time as far as these deemed supplies are concerned. Same issue comes in case of reverse supplies. You are having n number of situations, and in the roller coaster ride which we just talked about, we have seen everyone taking different types of positions. And some of you would agree that GST is actually an interdependent ecosystem. So you might say that I want to do a particular transaction in a particular way, but your customer or your vendor might not agree with that for various reasons. Maybe his interpretation of law is different. Maybe he wants a convenient or a shortcut answer. And in GST, unluckily, though that's not the correct legal principle, unluckily through circulars and various other notice clarifications, what the government has tried to do is, at various places they've given various alternative methods of treating the same transaction. Now, when you have alternate methods of treating the same transaction, it's all the more important that all the stakeholders in the ecosystem are attuned to the same answer. And I think a very common example which I will take a bit later is an example of a credit note. Now, whether a tax on a credit note can be reduced in the output side, itself the government gives you a choice. It says, if you want to claim the credit, these are the adjustments, these are the things which you have to do. If you don't do, we will not give you an adjustment. So therefore, as a supplier, essentially he ends up with a choice in a credit note, whether to give a credit note with GST or to give a credit note without GST, which we loosely say is a commercial credit note. Now, if I am a recipient of the supply, my accounting and tax treatment and disclosures will fundamentally vary on what the position the supplier has taken. And therefore, at lots of places, you find that there is an intermingling. And at times there is not an immediate exchange of information. So when the transaction happens, it happens with the business teams. The accounting and the tax teams are never in the loop into that. After 3-4 months, the accounting team will assume that the transaction has to be treated in a particular way. The customer or the supplier has treated it totally differently. And after 6 months, both the tax teams start talking to each other and defending the positions they have taken. And this is very common. It could be as simplistic as the GSTN of the customer, whether to take Maharashtra GSTN or Gujarat GSTN. And there could be a debate around that. And both the companies might take different positions. And end of the day, they will just keep on going on con calls and email exchanges without any resolution whatsoever. So that is where this fact that it is an interrelated ecosystem is a big change. To a large extent, we have adapted ourselves. The first few months were big learnings. Today, the amount of rectifications, the amount of errors have reduced drastically. But yet, this aspect, this mindset that it is an interrelated ecosystem is very, very important when we go into this entire discussion. Of course, this is the source from where you will get the identification of the outward supplies. You will get the valuations of those outward supplies. As a cross-check, you can also use your control accounts or the tax accounts which you have in your books and try to match the tax GLs. But honestly, only looking at tax GLs is not going to help. I am aware that some companies might just start with a tax GL dump, take that tax GL, fill up the GSTR 1 on the basis of that, and assume that everything else is reconciling. I think that may not be the right approach. The right approach would be to really start with your financials, have a reconciliation of that financials with the tax calculations, and then see whether your tax GL matches. So I think that would really close the entire loop in terms of the outward supplies side. Now these outward supplies, of course, from a tax terminology, from the GST terminology, have different classifications, and all of us are aware of this. I'll not take you through the GSTR 1 classification, which is your B2B, B2C large, B2C small, all of that. But typically from a tax implication, you can have a taxable supply, which again can be either forward charge or reverse charge, because you are paying the tax yourself by collecting and from the customer, or a reverse charge, like if you are a transporter providing a GTA service, you might be under a reverse charge mechanism. You will still raise a valid tax invoice, but you will tag that being liable for reverse charge, and therefore it's going to be the customer who will end up paying the taxes. You could be into zero rating. You might be into supplies of exports or on supplies to SEZ units, which are zero rated. Again, you have an option here on payment of tax or without payment of tax. I am aware in the first few months there had been a lot of confusion of where exactly to report all of this in B2B and into your GSTR 1 and GSTR 3B, resulting in some difficulties at some point of time. But today I think things are reasonably settled on what is to be reported where in terms of zero rating in case of payment with tax and subsequent refund, or without payment of tax and refund of ITC. Then you have all those cases where taxes are not payable. Again, we have classifications in terms of supplies which are exempted, transactions which are not GST supplies at all, transactions which are not a supply at all, like employee transactions or transactions in land, or transactions where India has no jurisdiction or there's no territorial nexus. For example, if you are a multinational company, you might have branches abroad, and the turnover of those foreign branches necessarily has nothing to do with your GST law in India. So you will say that there is no territorial nexus, and therefore you will classify it even though it's a part of your P&L account. The sales of a foreign branch would also be a part of your P&L account, but you will ignore that for the purposes of GST. So this is how you will broadly classify your transactions on the outward supply side. Now, having understood this, we'll go into some typical issues which are coming up, and of course these have been identified, many of them have been identified right from the inception of the law, but over the last 21 months, over and above the wisdom of the 620 odd documents from the government, we have lots of advance rulings. And this is one, what you can say, a disservice in the law, which has been done by the government and maybe even by the industry and by the consultants. So the law has a provision wherein you can apply for an advance ruling. If you have any doubt, you can ask to an advance ruling authority that this is my doubt, whether GST is payable, whether it is not payable, whether credit is available. Whatever question relevant to GST, you can ask, except a few questions which are not permitted to be asked. So what happens is, everyone, because it's a new law, wanted to ask questions. And India is a country where you are always inquisitive. So, and you always feel that, okay, I'll ask the question, he will answer. And if he answers, it's binding on the department. So I have a government document which says that, certain things have to be done in a certain way. So there was a deluge of people who applied for advance rulings, not realizing that the people who is going to give the advance rulings are from the department. There is no, unlike the income tax advance ruling authority, where you have a retired judge as a member of the advance ruling authority, in the GST advance ruling authority, you have two people, one from the central department, one from the state department. And they are of the level of the deputy commissioner. Now, for those who have been going into the department, especially the sales tax department, would know that generally a person starts in the sales tax department at a position like an inspector or something like that. And he could be a BA also. We have seen veterinary doctors who start their career in the sales tax department. And we've seen all types of different, the point which I'm trying to make is they need not have any commerce, finance or tax background. Every 3 years they get some promotion. And by the time they reach 50, they will become deputy commissioner. And that is the person whom you are going to ask a question in an advance ruling. Now what answers do you expect? But despite this, people went, and we have, I don't think anybody has a count, but I think at least 1,500 advance rulings already. And most of them will always say tax is payable. If you ask a question on credit, they will say credit is not available. If you ask a question on tax, they will say tax is payable. And they'll just have 1 or 2 lines to explain that, and that's all. But now the problem is, there are so many things which are now out in the open. And that creates a problem. Some important things which are relevant from a general audience over here, we've tried to bring out a few things, and as we go into them, we'll talk about our views. We do not give too much respect, honestly, to these advance rulings, because many of them do not really represent the law in the right way. But yes, they are there. So depending on the organizational profile, we will have to take positions on some of them. And if we have already taken positions, if required, you may need to revisit those positions. So we'll take a few issues around that. And I think the first issue, which had just started when service tax was going away, was this concept of notice period recovery and many things surrounding employees. So while employees are outside the purview of service tax and also GST, employee-employee relationship has always had sort of a love and hate relationship with the department. And while they don't want to tax employees, they also don't want to leave it totally litigation free. So you have this classic scenario where in the service tax regime, there was a company who had recovered certain notice period recovery from the employees. And typically, notice period recoveries are reduced from salaries. But this company, for its accounting treatment, disclosed it as other income. And said that, look, this is the money which in the full and final settlement of the employees was expected to serve 1 month notice period. He didn't serve. So I deducted some money from his full and final settlement and I treated it as other income. So far, so good. The officer says if it's other income, it has to be a service. If it's a service, you have to pay service tax. And that's where the entire litigation on this front started under the service tax regime. Now suddenly they said, okay, service tax, but under which category? Because they have a lot of obsession about these earlier categories. And now there's a lot of obsession about the HSN codes. And HSN codes is a story in itself. We'll come to that a few minutes later. But then they said, so we asked, what is the category? Now they scrambled it. You can't say it's business support. You can't say it's business auxiliary. You can't say it's legal services. So what is it? So suddenly they found one interesting phrase in the service tax law, which was to say, any agreeing to do an act or tolerate an act. Now, sir, they forcefully want to tax you. So they want to now create a story to say that when you are recovering a penalty from the full and final settlement, you are actually tolerating that employee going away. And therefore, and there are so-called notices to this effect. Therefore, the amount which is deducted from the employee's payroll is nothing but a consideration for your agreeing to tolerate the act of the employee leaving early. Now, my challenge is only this much, that if an employee wants to leave, we are working in offices, not in jails. You cannot force an employee to stay in office even for 1 more day than what he wants to stay. The Constitution gives freedom of employment to people. And therefore, there is really nothing which the employer can tolerate. He does not have any choice of toleration. It is just a monetary compensation for the investment which the employer has made, maybe in the training or the other things. It's actually a reduction in the salary. And that's the correct accounting treatment also. But in some cases, if people have treated this as other income, these actions have started. And once they have started, everyone knows about it. So suddenly when GST came, somebody said, let me ask this question. And say, we had similar questions on canteen recoveries and all. So people asked questions to the advanced ruling authorities. And as you know, advanced ruling authority always gives a negative reply. So now today you have a scenario where you have an advanced ruling saying that all of these notice recoveries, canteen recoveries are liable for GST. At the same time, there's this concept which says that essentially you are not rendering any service to the employee. And if you are not rendering a service to the employee, where's the question of any tax? Right? Now, this is where that tug of war continues. On a legal footing, we believe there is no tax on any of these aspects for three reasons. One is there's no service given by the employer to the employee. Secondly, the GST law has a wonderful catchphrase which says that supplies are taxable only if they are in the furtherance of business. If I am not supplying for furtherance of my business, then there is no tax on it. Now, when my employee leaves, it's not in the furtherance of my business. Sometimes I want that employee desperately. But yet, if he leaves, I have to allow him to go. In fact, it might detriment my business also if he is a key employee of the organization. So definitely, it is not in the furtherance of my business. And third important reason is employment contracts by themselves are excluded from the purview of GST. And this essentially is coming out of an employment contract. So on basis of these three reasons, one can argue that there is no tax. Many companies, the amounts are not material. People don't want, once in a year, an employee goes on a resignation. And maybe not in all cases, there will be an amount to be payable. And therefore, sometimes people say, sir, आपका show cause notice का drafting का fees ही ज़्यादा हो जाएगा. So on the grounds of materiality, let us just agree to pay. So this is where I would leave this point on employee recoveries. We believe that there's not taxable, but if the amounts are big, you can litigate. If the amounts are small, maybe you can consider paying. I am sure many of the organizations, we have already discussed this and taken some positions. Where we have not taken, just look at your positions, look at the amounts involved, and then take a position and accordingly go ahead on this front. So that is the first important thing which we thought we should revisit as far as outward supplies is concerned. And I think the necessary extension of this is scenarios where you recover some penalties or fines from contractors, or you recover liquidated damages because the contractor has delayed his work, or the service provider has not done the work to the appropriate quality. Here again, in the context of electricity companies, there has been an advance ruling from the Maharashtra Advance Ruling Authority itself, saying that liquidated damages are again agreement to tolerate an act. Again, according to me, this is an incorrect way of looking at it. The arguments which I kept for employees, same arguments should apply here. And ideally, according to me here also, these are examples of reduction in costs rather than really a revenue, rather than really an outward supply from your side. So this is the second basket of things which one needs to be a little bit careful about. The third, of course, is something which is to a large extent settled. And the fact that in GSTR you have a matching of credits per se forces people to settle things and do things in a particular way as far as reimbursement claims is concerned. So typically you always had a scenario that you will say that you will pay tax on the value of the service which you render, which is the value which you bill. But many times there are out-of-pocket expenses or expenses which you incur and then recover at actuals from the customer. And always there has been a question of whether such recovery of expenditure is liable for service tax and now GST or not. In the service tax regime, there was a concept of pure agent, which has been continued in GST regime also. Of course, the number of tests has been reduced from 8 to 4. So the concept which the government says is, if you want to claim any exclusion on account of reimbursement of expenditure, you have to satisfy those 4 tests and you have to become what is known as a pure agent. In today's world, finding pure water itself is difficult. So how do you find somebody who is a pure agent? And the conditions there are also tricky. One important condition, of course, is that the amount should be actuals. The liability to pay should be that of the service provider and not of the customer. And main important thing is it should be in addition to the base service rendered. If you are satisfying all those conditions, then you can claim a reimbursement claim. But the challenge in the reimbursement claim, especially in logistics sector, what we are finding is that the vendor would still raise an invoice in your name, or even if he raises in the name of the customer, he will not recognize the GST number of the customer. And if that doesn't happen, the underlying GST credit becomes a cost. And therefore, in many cases, intermediaries say, let me become impure rather than being pure. I'll take the credit of the vendor's GST and I will charge GST and allow credit to my customer. Life moves reasonably smoothly that way. Of course, your top line increases in terms of P&L and all, but that is what many have already adapted, and depending on the organizational structure, you can like to look at that aspect. That takes me to one of the most important aspects of GST, which is this entry, Schedule 1, Entry 4, talking about branch transfers. And we have had extensive discussions on this, including various flow charts and diagrams and scenario analysis. All of us are now reconciled to the fact that if an entity has multiple branches in different states, each state will need a registration, and each registration will be treated as a distinct person in itself. And therefore, one legal entity, one PAN number will have 10 registrations, and for the purposes of GST, you will be treated as 10 persons. And that's not all. What we are also told that if there are transactions between these 10 persons, those transactions will be deemed to be supplies. So if one branch sends goods to another branch in another state, that branch transfer becomes taxable. Earlier on F form, it was not taxable. Now clearly it becomes taxable. Goods, it's not a challenge because you have tangibility, and more or less everybody has set up processes. There's a valuation in your inventory records. So use those valuation norms and pay the tax, claim the credit in the receiving state. When it comes to other than raw materials and finished products or traded products, the challenges start. And a common example is branch transfer of assets. And that again can happen very regularly. Now, here again you will have to take a position whether the transfer of the asset is permanent or temporary. If it's a permanent transfer, then you will find the underlying value of that asset and pay the tax on that and claim the credit in the other state. Here, of course, we will revisit this when we go to the input tax credit provisions on assets also, because there are certain challenges on that front as well. But many a times you might send an asset for a particular work and bring it back. And it's a temporary movement in that sense, maybe for 3 months, 6 months or so. In that case, maybe you can look at something known as a hiring policy. You can say that I am not permanently transferring an asset, and therefore I will only recover the higher charges for that period for which the asset is deployed in another state. And that brings me to a larger question. That does this provision require all interstate movement of goods to be against a GST? And according to me, despite the entry, the law doesn't talk of saying that all interstate movement of goods will trigger a branch transfer. And a couple of examples, the law itself in the circular they have given. They have said that if I am providing a construction service, and for providing a construction service, if I am required to move an asset to the site, and that site is in some another state, that doesn't mean that I am transferring an asset to another state. It is still a movement of goods for providing a service, and this is not treated as a branch transfer. So you will actually have to see whether there are two branches involved in the transaction, and if the asset or the goods are moving from one branch to another branch. If there is no movement from one branch to another branch, but it's only a site of the first branch, and the other branch has no role to play in that entire process, perhaps that would not become a branch transfer transaction. And on a case-to-case basis, of course, an easy answer always is look at your inventory records, look at your movement records, pay tax, claim credit. It's always safe to be conservative. But yes, if there are tax implications, especially if you are working in exempted projects, and now with real estate, for example, being under the no input tax credit zone, restaurants being under no input tax credit zone, all of this may become relevant in that scenarios. So that is something which we have to look at. The larger difficulty comes in case of services, because the basic attribute of service is that it is intangible. And that's where in implementation we've talked about two types of branch transfers of services. One is project-related branch transfer, which we at times also talk about as direct branch transfer. You might have scenarios that you are working for a single project. The revenues for that project are booked in one state. The costs are booked in some another state. And because the costs are in one state and revenue is in another state, you have a cost-revenue mismatch. And we typically address this cost-revenue mismatch by doing a branch transfer from the cost incurring state to the revenue incurring state. And therefore, necessarily the credit accumulation also gets resolved. And this has been, at each of the cases we've tried to discuss, we tried to work upon and build upon some MIS which the organization has, and try to find out state level bifurcation of the costs and the revenue, and then try to match the two and then do a branch transfer. Periodicity, depending on the type of the organization and the complexity, ideally we suggest monthly, but it can go all the way to yearly also in certain cases, depending on the volumes and the values attached to this transaction. As far as indirect cost is concerned, and this is where you have a lot of challenge and lot of subjectivity coming in. You have a head office in Maharashtra, you have a corporate office here. There are various expenditures incurred in the head office. Let's say a telephone expenditure. Now this telephone is used for servicing activities for 10 different states where you are registered. So there is a common cost which is there in the corporate office, and the question is, can one therefore say that the corporate office is rendering services to the branch, and therefore these services also should be valued and taxed? Now there is an elaborate legal theory to say that you cannot look at it in this fashion, for a simple reason that only the GST law requires the person to be a distinct person, but the general law doesn't require you. If I am an employee of the company, I am an employee of the company. I cannot say that tomorrow, because I am stationed in Maharashtra, I will not do any work relating to Gujarat. My employer will immediately throw me out of the company if I tell him that. So each person is an employee of the company, of the legal entity. And that employment law is not amended to say, no, now employee has a protection, he will only work for this state and not work for another state. In that context, whether one can really, what the government and some of the officers are trying to do is to say, you pick up each employee, you pick up each asset, you pick up each property, and link it with one of the GST numbers, one of the branches. And then if you have one branch owning an employee, so-called, and that employee is working for another branch, do a branch transfer. And there is already an advance ruling to this effect. So the question is whether this is legally tenable. According to me, there is a big doubt on legal tenability of this proposition. But again, in many cases, it's to the advantage of the organization to do a cross-charge. A very simple type of a cross-charge which we have advocated in many of the organizations is, look at all the common expenditure in the head office, total that up, keep it at one side, look at the turnover of all the branches, and divide this expenditure in the ratio of the turnover, and do a cross-billing according to the turnover in the respective states. Charge GST, claim the credit. This is a common type of a solution in many organizations. In some organizations, we've tried to do a fixed cost, fixed value. In some cases, we've done a percentage of the revenue. Different approaches have been taken. But a safer stand is to do something rather than do nothing. Now, when you're doing something, it becomes all the more difficult. Doing nothing is the most easiest thing. Moment you say, I want to do something, questions start. आपने बोला common expenditure लेना है. So what all is there in the common expenditure? I will say consultant's bills, because consultant works, let's say we file your GST returns. We file it for all your 10 states. So our bills, necessarily, logically, you should divide it into the 10 baskets, 10 states. So all GST cost related items, I think up to that clients are happy. They are fine. They say, okay, up to here, it's okay. Then our team comes and says, sir, you have to take electricity also. Because the electricity spent in the corporate office is spent so that each of the branch managers can come here, sit there in the conferences they attend, and ultimately the effect and the benefit is of the electricity also is going to all the states. And then somebody comes back and says me, sir, why not salary itself? Because the marketing manager of the company sitting in Bombay does not market products only for Maharashtra. He markets product for the entire country. The product manager works for the entire country. So why not salaries also should be taken for the common cost? And that is what this advance ruling is all about. It says all the common costs, including salary cost, should be taken as a part of the cross charge. In many cases, it may really not matter because credits are available. The Columbia Asia advance ruling, for them it really mattered because it was a hospital, and a hospital typically renders exempted services not eligible for credits. And therefore they had a challenge, and they are now really in a big difficulty on that front. Government also realizes this. They are also smart. They don't want unnecessary litigation. So what they say is, where recipient unit is eligible for full input tax credit, I will not question what you do. And for 80 to 90% of our clients, that's a big comfort zone. If you are not having any exempted supplies, if you are all your branches are claiming full input tax credit, they are giving you a concession. Even if you do a 10 rupee value, we will accept it. We will not question your valuation. And therefore, the thought process is, please do something. Don't worry too much about the last mile valuation. You might have some valuation principles which you may not totally apply, but so long as all your units are eligible for full input tax credit, do something for the sake of doing it at least, And then when the officers question you, you can always bring this proviso to Rule 28 and show him that proviso to say that you cannot question what I have done. So long as I have done something, the value has to be acceptable. So strongly advise that if you have not done something, please relook at this process of branch transfer of services and please do something on it, at least something. What to do, that's another thing, and we can talk about it individually as and when required. That takes me to the next aspect, which of course has nowadays come up too much in the media also, and that all started with the concept of banks, wherein they started saying that if a bank has a logo, and all the banks have a brand name and a logo, each of the branch is using that logo. So they are saying that there is a supply of a brand from the head office to the branch offices, or from the subsidiary, main parent company to the subsidiary company. And even that brand name should be valued and there should be a tax on it. Now the question is, the valuation of these items can be very, very subjective. Again, a suggestion is to have some notional valuation, maybe a very small fractional percentage of sale, or maybe a fixed amount per month, and move out of this entire debate. Otherwise, these debates are something which can last for decades. They are advocates' delights more than anything else. So that is the related persons provision. That takes me to the next area of compliance, wherein we see there's a reasonably good amount of lack of awareness or non-compliance, which is job work supplies. The definition of job work is very wide. We are talking about any treatment or process undertaken by a person on goods belonging to someone else. So typically, if you look at this, if I send my laptop for repairs, the person who is repairing it is doing some process or a treatment on my laptop, and that laptop is belonging to me. It's done by someone else. So even a simple example of me sending a laptop for repair and getting it back in a couple of days could be, someone might say this is a job work. Now, according to me, the intention of the law is not that. The intention of the law is very specific, only where a job worker is actually undertaking some element of manufacturing or some fundamental processing on behalf of the principal, that one will cover it in the job work provisions, not any simplistic treatment or processing like testing, or sometimes you just do a small powder coating, or you just touch up a particular product and do some finishing on that. I don't think all those things should be ideally treated within the scope of the job work. Now, what happens for job work? Now, in excise, because the tax was on a manufacturer, job work had a very important relevance. And we had lots of case laws wherein the job worker was held to be liable to pay duty. In some cases, manufacturer being held liable to pay duties and things like that, because there was clearly an escapement of tax. Now, when we come to a transactional tax like GST, honestly, job work, manufacture, these concepts ideally should have been dead. But somewhere we want to continue some old things, so it's there. So what are the compliance requirements? Typically, they say that if you send some goods to job worker, inputs to a job worker, bring back the processed goods or the inputs back within a period of 1 year. If you send some capital goods or molds or dies, bring them back within 3 years to your own premises or directly to the customer location. And then there is a requirement of filing a quarterly return in ITC 04, a very complicated form wherein you have to put all the quantitative details, which is there. So these are the compliance requirements. As far as possible, try to do this. But again, we always ask this question, what happens if you are not compliant? For the first question, where you don't bring the goods back, there's a very specific provision which says that I sent the goods on job worker. Let's say I send it today. After 1 year also, I do not bring back the processed goods. Then the first goods which I sent on job work on a delivery challan, because I didn't pay a tax, it was not a supply, is now deemed to be a supply. I have to go back on that day and pay the tax on the past date when I actually delivered the goods as a manufacturer to the job worker. So it's a messy provision. You have to pay interest for that entire year and things like that. But most of the people would actually bring back the goods within 1 year, unless it's a very long capital intensive project. Most of the times we find there are non-compliances on other aspects, like specifically the challans to be prepared or the returns to be filed. Now, if there are non-compliances on that front, the fear which many people have is whether this will disentitle me from the exemption or the exclusion, and whether I will end up paying a tax. In my view, you will not end up paying a tax, because there is no provision which says that a movement of goods from your place to the job worker is a taxable supply. Therefore, you will not end up paying a tax. The only impact which will come is you have not filed your ITC4 or you have not prepared the delivery challan in the manner prescribed. So there is a general penalty of 10,000 rupees for any default which is not specifically listed. So you might have a general penalty of 10,000 on that front if you are not complying with these provisions, which may be noted. This is the point which I just started my discussions with, discounts. And the basic challenge which comes is provisions of section 15 and 34. When you read both of them together and when GST was implemented, what emanated out of these two provisions was that if you want to claim a GST reduction on account of discount, you have sold goods at 100, you are then given a discount of 10 rupees. When you sold goods at 100, you paid the GST on 100. Now you want to reduce the GST of 10 rupees from that 100 rupees. You want to claim a reduction. For that reduction, there were a few conditions which were required to be satisfied, which continue even today. The first condition is that the discount should be a part of a rate structure which is agreed prior to the making of the delivery or prior to the supply. Second is you have to issue a credit note which has to be issued before September of the next financial year. Now, of course, there are lots of relaxations on this front, and though there is no explicit relaxation on this front, we believe that for 17-18, this relaxation applies up to March 19. Just like your ITC relaxation and amendment relaxation applies, according to us, this relaxation also applies up to March 19. The third condition, and this was a pain in the neck for many IT people and the systems guys, is that the credit note will have to be linked one-to-one with an invoice. And this was really a nightmare, and people put random invoice numbers in the first few months. I'm aware that, if there are 50 invoices against which you want to give a discount, it's foolish to prepare 50 credit notes. And when you prepare one credit note, you have to link it with one invoice only. So randomly people used to link with the highest value invoice or something like that. Luckily, this has been done away with in the Amendment Act. Effective from 1st of February, we are told that the credit note need not be linked one-to-one with an invoice. When I'm telling this, I also need to tell you, in India, in GST, we have different types of laws. One is the law, which is the GST law. One is the portal-made law. Because something might be there in the law, but the system will not allow you to do it. And there's no other way you can do things, except through the system. And this is a classic case where the law has been amended since February, but I understand till today, the system requires an invoice number to be mentioned against a credit note. And therefore, by force, you have to put some random invoice number, which you were anyways doing in the past. At some point of time, the system will get changed, then this will be really the correct law. But as of today, there is this disconnect. And the fourth important thing is the buyer should reverse the credit, because he would have claimed credit on 100. Now, when you are giving him a discount of 10, you are taking back that tax, output tax from the government. So necessarily, the input tax credit of the buyer should be reversed. Now, when you look at so many conditions, many companies who gave discounts found it difficult how to implement this and then how to monitor all of this. So they said, why can't we do one thing? We will give you discount, but we will not give you the GST back. So when I raised an initial invoice of 100 plus 18, you pay me 118. Now I am giving you a discount of 10, but 10 I will give you only 10. I will not give you 10 plus 1.8. You have anyways taken the 18 rupees credit, so why are you worried? This was the narration or the dialogue between the manufacturer and the distributor or the dealer. Now the distributor dealer is worried because there's one more condition in the law which says that you have to make the payment to the vendor within 180 days. Now necessarily he has received an invoice of 118. Out of that 10 rupees is a discount. So to the extent of 10 rupees he has not made a payment. So the buyer is worried that will I be forced to reverse the credit? And there were two views on this. Luckily now there is a clarification which says that this type of a credit note, we generally say it's a financial credit note or a commercial credit note, no GST impact. And they've said that these types of credit notes are valid. It's an option of the manufacturer to give a GST credit or not give. And if he does not give that GST impact on the credit note, it will not result in a reversal of input tax credit in the hands of the buyer. So luckily now the situation is a little bit simpler. You can give a commercial credit note. The seller will not claim a output tax reduction. The buyer will not impact an ITC reversal. So to that extent helps in some way. But while all of this was happening, this happened in February 19 and law was there from July 17. And people have to find workable solutions for everything. So many people found a workable solution to say, एक काम करो, मैं आपको 10 रुपया डिस्काउंट देना है, लेकिन instead of me giving you a credit note, why don't you give me an invoice? And this has happened left, right, and center in the industry. The person who is receiving goods or services is expected to raise an invoice on the supplier, which I will now loosely say is reverse supply invoice or a reverse invoice. And they say, okay, you कुछ भी लिख दो ना उसमें, commission लिख दो, marketing लिख दो, और invoice दे दो, आप tax लगा दो, मैं credit ले लूँगा. This is the common language which is floating around. And a classic example is pharma companies, and of course, it applies to many FMCGs and product companies, wherein a manufacturer sells medicines to the chemist, to the distributor to the chemist, and chemist to you. Now, each of the medicines has an expiry date, and it's an accepted trade principle that if a chemist has an inventory of expired medicines, he's not going to bear the cost of that expired medicines. He will push back those expired medicines all the way back to the manufacturer, and the manufacturer has to bear the cost of it. It's a established, settled practice in the industry. Now, when you push back those expired medicines, which happens 2 years down the line, and one of the conditions here is 1.5 year mein credit note hona chahiye. So, it was not practical. So, many pharma companies told the chemists, एक काम करो, आप goods rejection के लिए purchase return नहीं दिखा के, you show it as a sales. And raise an invoice of expired medicines. So chemist raise an expired medicine invoice on the distributor. Distributor raises a sale bill for expired medicines on the manufacturer. And then they were worried कि कैसे होता है? How can this happen? And they took it to the government. And interestingly, the government gave this as a choice. The government said, you can have a reverse supply invoice like this, or you can have a credit note, either of the two. Now this is, wherever the government gives choices, I am a little bit uncomfortable. Because when you give choices, supplier wants to do one thing, buyer wants to do another thing. And then both of them just don't agree on anything, and both their consultants never agree on that thing. And then the transaction just becomes, goes in circles and circles and circles. But well, this is what they have said. They've said that, they've given the example of pharma, but they've said this applies to other products also. It could be an FMCG product, electronics, anything. In my view, this is a fundamental difficulty, because there is a fundamental difference between a purchase return and a sale. More importantly, I don't know which law permits a chemist to sell an expired medicine. Tomorrow, FDA can be put him behind bars that you are selling an expired medicine and you are not permitted to sell it. Now, these are the things which one has to be careful about. You look at restaurants, they are not permitted to sell a stale food. Now, if they sell stale food or expired food, tomorrow somebody might catch them and say, what are you doing, boss? You are not allowed to sell these goods. So that is where one has to be a little careful. Though the circular does permit it, I would use it only as a last resort. I would first try to continue with the credit note game. If the credit note game is just not workable, then only look at this as an option. That takes me to the next area, which is sale of fixed assets. And of course, these provisions have been there since quite some time. But the real impact and the rigor of it is now being felt. So I thought we'll just bring it out to some extent. So as far as fixed asset sale is concerned, motor cars, of course, has a separate treatment because there is no ITC credit anyways for that. So what we are told is the value when you sell an old motor car would be the margin. You are allowed to reduce the WDV as per the Income Tax Act from the sale price, and only on the difference you have to pay the tax. Now it's easy to say, and it's good that you have to pay less tax. But I'm sure many accountants here would curse me when I'm giving this type of a law. Because they have set up a system to say sale price into 18% tax भर दो, खत्म हो गया. एक tax code करके है, जहाँ एक tax rate बिठा है 18, 28, 8, whatever it is. And there is a value which comes from your transaction value, and your ERP or tally maps both of them and multiplies it and gives you the rate, value of tax. Moment you have something like this, वो automatic नहीं हो पाता है. Because your ERP doesn't know the WDV as per the Income Tax Act. So every time somebody sells a motor car in your organization, they will have to come back to the accountant and ask him कि इसका WDV क्या है income tax के हिसाब से. काफी बार accountant को भी नहीं मालूम होगा क्योंकि income tax team अलग होगा, GST team अलग होगा. Then you have to go back to those guys, get the value, and then find the margin and then pay tax on it. So it increases paperwork to a large extent. It increases to and fro. But yes, a concession where you can pay a lesser amount of tax because the value itself is reduced. If your asset is purchased prior to the GST regime, they further give you a reduction in the effective tax rate also. They tell that you will only treat 65%, and accordingly there is another notification which says old assets which are sold now, the tax rate also will go down. Our practical experience is in quite a lot of cases, the value comes down to zero, or at times negative also. Negative, of course, will be ignored. And if it comes down to zero, then you don't need to really worry too much, because then you don't end up paying a tax. Otherwise, also the value which comes is very low. So you can just calculate it, and accordingly, based on the engine capacity of the car, there are different tax rates which are applicable, which you will have to apply. That is as far as motor cars is concerned, which is a very specific type of a thing. For all other fixed assets, you have to pay a tax on sale value. And this is where people are happy. Okay, you just take the sale value, plot the GST rate on it, and pay the tax on it. यहाँ चले जाता है, सबसे पहले पूछते हैं इसका HSN कोड क्या है, because you have to plot the HSN code and the tax rate will be dependent on the HSN code. So yes, but these are one-time efforts which are required, which will have to be taken. But I think the larger difficulty which is now coming up is, if your asset was purchased in the GST regime after 1st of July, you would have claimed input tax credit of the GST on it. Now there is a specific section, section 18, which now will start slowly triggering. In many cases, it may not have triggered at all, which says that if you have an asset on which you have claimed the credit, and if that asset is later on sold off by you, then you have to make sure that either your transaction value is equal to some depreciated value as per that section. So that section gives you a 5% per quarter depreciation rate, irrespective of the type of the asset. So I'll take a common example like a laptop. So let's say you bought a laptop in July 17 at 1 lakh rupees. You took the credit of 18,000 which was there on that. Now today you like a better brand, so you want to sell that laptop and buy a new laptop. Naturally today when you sell it, 1 lakh ka electronics depreciate fast in the market, you will hardly get 20,000 for it. Now what the law says is, you have completed only 2 years, so only 40% could be a write-off. So though you had bought at 1 lakh and you are selling at 20,000, you will pay tax on 20,000. That is very simple. But on the ITC front, you are told that 1 lakh minus 40,000, which is a depreciation for the 2 years, 60,000 का WDV होना चाहिए था. आपने sell किया 20,000 में, तो balance जो 40,000 बच गया, that 40,000 you have to reverse the credit on that. So you had claimed credit on the full 1 lakh. But you shouldn't have kept on 1 lakh. On this 40,000, you have to reverse the credit. Now this will start triggering in, because now you will find situations of examples of July, August ka assets being sold in larger organizations. So this is something which you will have to be a bit careful about. Now when we are looking at this, this has some ripple effect on branch transfer of capital assets as well. Because many a times when you are doing a branch transfer of capital assets, you will do it at book value. Most of the organizations do branch transfers of fixed assets at book value. Now that book value will be as per the depreciation rate under the Companies Act. Whereas over here you have a 20% depreciation rate, which is a fixed rate. So if there's a disconnect between these two rates, you might end up having a valuation related issue on branch transfers as well. Another issue which comes is what happens when you give your assets free. Sometimes laptops, you don't want that 10,000, so you give it to an NGO free, and say that, okay, so you give it to some school as a freebie. Now, if you dispose an asset otherwise than for a consideration, there is an entry in Schedule 1 which says that if you have taken ITC, this will be deemed to be a supply, and you will still, even if you have given it to be free, you will still have to find the market value and pay the tax on that market value. So again, over there, free disposals also will create problems as far as fixed assets is concerned. So that is on the fixed asset side. We now go on to the next area, and that is zero rating. In the months of July and August 17, it was what you can say a lot of furor, lots of newspaper reports, exporters stuck with lots of refunds and things like that. We've come a long, long way thereafter. But yes, there are some stumbling blocks, and I will just touch upon a couple of them which are happening right now, and some newer issues which are coming up. And I think the zero rating, there are two important baskets of zero rating. One is when you supply to an SEZ unit or a developer, those transactions are zero rated. And when you supply to a foreign customer, it's treated as an export. So both of them are zero rated. Zero rating concept, all of us are aware, you don't pay tax on your output side. At the same time, you get a credit or a refund of the taxes which are paid on the input side. So there is no loss of credit at any of the forums. That is the thought process of zero rating. In that sense, it's the most best case option in the entire structuring. Now, when you are looking at supplies to SEZ, there is one provision under the IGST Act which says all supplies to SEZs will always be deemed to be interstate. Now, SEZs will be within the same state also. And that was where I think the first question which was being debated was that when I'm supplying to an SEZ within my own state, should I charge C plus S GST or should I charge IGST? There's a circular which handles this and talks about saying that it will be IGST, and that's the correct legal proposition. The circular, then comes the next aspect. Whether, having said that it is a supply to an SEZ and therefore IGST, whether zero rating will be allowed or not. And that is where the circular says, so long as the supply is for an authorized operations, the zero rating should be allowed. But it is important to demonstrate that the supply is for an authorized operations. Now, when you have these types of one or two wordings here or there, people get a little bit worried and then they start filing advance ruling applications. And that's what happened here. There was an advance ruling application which was filed, the answer to that was in the negative. Then the matter went to the appellate forum, then the AAAR answer, the appellate forum also gave a negative answer. And the questions there were something like this, that if there's a hotel management or if there's an event management service taken by an SEZ unit, whether there's a zero rating available for that. And this advance ruling says, no, these are not used for authorized operations and therefore zero rating will not be allowed. Now this is where I think somewhere people have not understood what is meant by authorized operations. What they are saying is, होटल है वो SEZ के बाहर है और वहाँ तो कोई सोने को जाता है, तो वो बिजनेस के लिए कैसे यूज हुआ? Not realizing that the person who's staying there has not gone with his family for a fun trip. He is maybe 500 miles away from his family, staying alone, so that he can attend a marketing and a business trip on the next morning. And that is clearly a business of the SEZ to do that. But people don't understand that. And therefore, the AAAR says, all of these are outside, they are consumed not for authorized operations, then therefore zero rating will not be allowed. Of course, this is going to be litigation prone. We strongly believe that all of these are authorized operations, unless you are able to demonstrate that the employee had gone on a fun visit, on a LTA or on a personal visit, that's another thing. But if he has gone on a business trip, clearly zero rating should be allowed. We have walked this journey in service tax prior to 2011. We have seen lots of cases where all these credits were being disallowed. And then we had that Ultratech cement decision of the Bombay High Court clearly allowing all these credit. Maybe we'll have to walk back that journey once again under the GST law. So that is what comes as far as the SEZ units are concerned. That takes me to the second area, which is export of services. Lots of conditions under the IGST Act when you want to treat something as an export of service. Important ones being that the recipient should be located outside India, your client should be outside India, which is more or less fine. You always have these examples where your contract is with a foreign company. Second is that you have to receive the money in convertible foreign exchange. Now, this is where when you have receipt in convertible foreign exchange, we had challenges for transactions where, for example, Nepal and Bhutan. The RBI has a treaty whereby you are permitted to receive money in Indian currency, and that Indian currency is treated as equivalent to foreign currency, especially transactions with Nepal, Bhutan. Sometimes the RBI permits you to set off your remittances against your receivables, and they treat it as a deemed convertible foreign exchange. Now, this is where the amendment in the GST law from February comes to effect. What it says is, if the RBI permits this as a deemed convertible foreign exchange, then even though you receive the money in Indian rupees, we will allow this transaction as an export and we will treat it as a deemed receipt of convertible foreign exchange. To that extent, it's a good welcome change which has been brought about. One important thing which comes is in the provisions of the IGST Act, they just say that you have to receive the money in convertible foreign exchange. They don't tell you the period within which you have to receive it. But suddenly when you find the rules, in the rules there is one requirement that you have to get what is known as an LUT. And lots about LUT we'll talk. It's a long story and it's a useless paperwork which they are forcing people to do. But be as it may, there is a letter of undertaking which each exporter has to file before he gets this zero rating. And the content of that letter of undertaking says that I will get foreign currency within a period of 1 year. And because there is a 1 year condition there, you have a rule which says you have to get the money within 1 year. If you don't get the money within 1 year, apply to the commissioner, seek an extension of 2 months. But basic law में कहाँ है कि मुझे 1 साल में लाना है? वो कहीं नहीं है. But well, that 1 year condition comes through the rule. Whether that rule can override the act is a challenge. If you are having scenarios where your exports monies are not realized within a period of 1 year, write a simple letter to the commissioner. Commissioner most of the times does not reply to that letter. He keeps it in some waste paper basket. Let him keep that. You will assume it that it's a deemed approval and we'll move ahead on that front. But yes, this is something 1 year condition which is somewhere superimposed into this entire provision in some manner. That takes me to the next one, which is the place of supply. And this is very important. The law says that the place of supply should be outside India. And then we had a very detailed session earlier when we talked about various places of supplies. So immovable property basket, performance basket, recipient basket. Necessarily, if your transaction is a recipient basket, then only you will be able to demonstrate the place of supply outside India and accordingly claim the export benefit. So typically, if you are, let's say, giving some consultancy services, the place of supply will be outside India. Now, generally, all of this is fine, but in the Amendment Act, they've tried to bring in a well-intentioned amendment, and which is what governments many a times do, tries to bring in a well-intentioned amendment without realizing the repercussions. So their objective was that they wanted to treat export freight as an export of service and therefore not liable for tax. Objective is very noble. So they amended section 12, subsection 8, to say that if there is a transportation of goods either by ocean, air, or even by courier or mail, in all these cases, the destination of goods will be treated as the place of supply. And then their explanatory note says that we want to incentivize these guys and therefore we are doing it. We want to give a level playing field. We want to incentivize these guys and therefore we are doing this. Now what has actually happened is exactly the reverse. Why am I saying this? The transaction is between two Indians. Let us say you go to a courier company. You are a manufacturer. You go to a courier company and there's a consignment which you give to DHL and tell them that you please export this to Germany on my behalf. Right? Destination of goods is outside India. But you are in India, the service provider is in India, service receiver is in India. So the first condition does not get satisfied. Right? If the first condition is not satisfied, it is not an export, tax becomes payable. Now which tax to pay? Now which tax to pay? Because you have C, S and I is the law. So which tax to pay? That will depend on the place of supply. Right? In the first sessions we have studied that location of supplier and place of supply, combination of that will determine whether it is C plus S or I. Now here, the location of supplier is DHL Mumbai. Place of supply is not your location, which is XYZ Mumbai. But the place of supply now is outside India. So location of supplier Mumbai, place of supply outside India, the transaction becomes IGST. Even though he is in Maharashtra, you are in Maharashtra, transaction becomes IGST. Now that brings the next challenge. DHL does IGST. आप सोचते हो मैं IGST credit ले लूँगा. लेकिन जब DHL has to file his GSTR 1, portal has its own logic. So now comes the portal-made law. And what the portal-made law does is, he compares your GST number and he compares the recipient's GST number. And if both of them are 27, which is Maharashtra, it will not allow you to type I. But DHL has charged I. So what does he do? He finds a workaround. And what is that workaround? He will put some different place of supply. Because if he wants to make it I, he will have to put he can't change your GST number. Because if he puts a wrong GST number, that also they will catch in the portal. Right? So what he will do is, he will change the place of supply. He will put GST number of Maharashtra, 27 wala hi. But place of supply, जो generally वो blank छोड़ता है, वो blank नहीं छोड़ेगा. He will try to put something other than 27. Now what other than 27? He can't put Gujarat. He can't put anything. So what solution most of them have found is they put a code called 97. Now 97 is other territories. Now that other territories is actually meant for the no state area like the ONGC, Bombay High and all those things. It's not meant for outside India. Otherwise they would have said outside India. Other territory would definitely mean Indian territory, not something which is not Indian at all. But well, that's what they put because otherwise they can't file their return. Moment they put 97 as a place of supply, in your GSTR 2A, you get a place of supply which is not Maharashtra. And therefore, immediately the question comes, if the place of supply is not Maharashtra, can I claim credit? This is an export courier freight which is integrally connected with a manufacturing and trading and export activity. But you will start facing challenges on credit. And we go back to the original history to say that there's a ring fencing of credit. Each credit has linked with the place of supply because the state where you tag the place of supply gets the money. So if 97 gets the money, 27 cannot give it back. And you are not registered in 97. So there's going to be a fundamental challenge on the credit. We believe that the GST law, nowhere, while logically it should do this, nowhere in the law, place of supply is a required condition for claim of credit. So depending on the amounts, there will be litigation, but yes, this is something which is a big issue which is floating around as far as ocean freight and couriers is concerned. Ocean freight, luckily what has happened is, there's one more exemption notification, which is there up to September 2019. So up to that, at least ocean freight will not create a big problem because people won't start charging you. But couriers, we have started facing this challenge day in and day out on this front. One more issue which is coming from advanced rulings is interpretation of this phrase intermediary. And there is this entry called intermediary where they have said we don't want to give export benefits, we'll treat the location of the supplier as the place of supply and therefore it will always become C plus S GST. Typically they wanted to cover examples like travel agents, tour operators, ticketing agents and those types of small players. But essentially the way they drafted it and the way our officers can interpret it, what they've tried to do is, they've tried to extend this to anything and everything where there are three parties involved. And we have an advanced ruling in the context of BPOs and call centers, wherein a view has been taken that a BPO necessarily facilitates a supply of a credit card service if it's selling a credit card or telling the account balance of a credit card. He essentially sells a credit card service, the BPO entity, of the bank to the third party, and therefore is an intermediary. Because he becomes intermediary, export benefits will not be allowed. And I'm sure all of you must have read this. This had come up in the media big time, and that's an issue across most of the software companies today. According to us, this won't fall as an intermediary. These are principal-to-principal services. Intermediary services can cover only pure cases of commission agents, nothing beyond it. But well, that's how the law is, and this is what we're trying to say. LUT we already talked about. There's a piece of document, a theoretical piece of document which has to be signed. 2 witnesses are required, and every year you have to make sure that you renew it. So this financial year is over. I'm sure those who are into exports, our offices have reached out to you. If by any chance you missed the mail, please make sure that in the next week you ensure that your LUT is renewed. Having said that there's zero rating, there are 2 options as we already talked about: without payment of tax against an LUT, and you can claim refund of accumulated ITC. Only thing which you need to make sure is you get refunds of inputs and input services. The credits of capital goods are not refundable at your end. And as far as inputs and input services is concerned, 90% provisional, 10% final refund, and I think reasonably smoothly things have now settled on this front. Another option which many times we recommend is you export on payment of tax, and maybe you pay this tax either from your cash ledger or from your credit ledger, and then file a subsequent refund claim. Now, if you are an exporter of goods, this is more or less become smooth. You just have to make sure that your documentation is correctly done. Your shipping bill and your GST invoice are mirror images of each other, and they follow in a correct fashion. If they follow in a correct fashion, through the customs route, the GST refund comes reasonably fast. So if that happens, that is one option which we are saying. Second is, if as far as services are concerned, you will still have to apply to your GST officer. There we are seeing some element of time which goes into the processing of the refund claim. Both these cases, it's 100% refund. There's no 90-10 concept in this. Of course, please note, make sure that if you are a trader exporter and you have procured against that 0.10% option, then you cannot go under this route. You are not permitted to export on payment of tax and rebate. So both of them are exclusive of each other. So that is something which you need to be careful about. On the outward supplies, on the tax front, these are the things. There are many other things wherein there is no tax, but yes, life has various baskets. So here you have 3 major baskets, and I think all of them will discuss from 2 perspectives, whether these transactions need reporting in your GSTR 3B or GSTR 1. Here also there have been divergent practices across organizations and a lot of confusion. So maybe if we know about it, we can rectify that in the March return. there are examples of what needs to be reported in the return. And second impact which you have to look at is whether these transactions will result in some reversal of input credit on my common expenditure. Because there is something known as section 17(2), which says that if you have some exempted supplies and there are certain expenditures incurred for exempted supplies, you cannot claim full credit, you have to claim a proportionate credit. So what is the impact on that? So these are the two dimensions in which we will try to discuss this. As far as not a supply is concerned, transactions of sale of land or completed building because of the GST amendment recently, these are to be treated as not a supply. No disclosure is required, no reversal is required on this account. Any employee transactions, the same answer. And more importantly, and this is a very welcome change, wherein there's somewhere, of course, one is to understand something from a conceptual perspective, and second is to have an elaborate law. And what we have tried to do here is now we have an elaborate law on the same lines what ideally it should have been. Now, what are these examples? And this has been an issue of discussion right from July 17. There are transactions where the goods do not enter the Indian territory, the so-called Indian territory, and are sold from outside India to outside India. So I am sitting in India, but I will go buy goods from US and sell it to China. Now, this was something where we always believed that India has no jurisdiction. Mal India mein aaya hi nahi hai. It has gone from US to China. India has no role to play in this transaction. But there was a set of thought, some consultants used to feel, that there is no exemption for this. You are an Indian, and there is no exemption to this, so why you should not pay GST? Because income tax, you pay tax on global income if you are a resident. So somewhere misguided by that thought process, there was a school of thought that all these transactions somewhere become taxable. And that was really not the intention. And therefore, what the government has done is in the GST Amendment Act, they have in Schedule 3 included certain types of transactions, which they agree that they are outside the Indian territories. So they have said supply of goods from outside India to outside India, supply of goods in a bonded warehouse, or supply of goods while they are on high seas. So all these three types of transactions, they have said, we will categorize them as out and out transactions. They are neither supply of goods nor supply of services. So no disclosure, no ITC reversal, nothing required. Now this brings me to the next thought process. They've talked about this for goods. Can this apply to services? I might procure a service abroad and consume it abroad. And this is something which I'll just leave it as a school of thought for you. A very convenient and a conservative answer is to say that you pay tax on import of service and claim export benefit. But whether that's the correct way or whether this is something which explains the concept more better is something which we'll leave as a thought right now. And on a case-to-case basis, whenever required, we can discuss it in more detail. What is more interesting is the exempted supply. The second one is simpler. Non-taxable supplies which are deemed to be exempted supply will require disclosure and also a reversal, which typically is your petroleum products and alcohol. Both of them have been kept outside the purview of GST. All of this sale of alcohol in restaurants, we require a disclosure. If you are ITC restaurant, meaning that you are eligible for ITC credits, in that case, you would still require a reversal on account of alcohol supplies. In other cases where there is no ITC 5% scheme, anyways there is no ITC, so there is no question of reversal. So this is a non-taxable supplies, petrol, diesel and alcohol. The more important and an interesting area is the third basket, which is exempted supplies, wherein we have to generally look at disclosure as well as reversals. It could be a goods which are liable for nil rate of duty. It could be services wherein there is a nil rate of duty or an exemption through a notification. It could be a scenario where you are providing services on which tax has to be paid by the recipient, because here we are told services on which RCM is applicable will be deemed to be exempted supply. So if you are a print media and you are also doing a sponsorship service, then to the extent of sponsorship services, it will be treated as an RCM and therefore there will be an exempted supply. Up to here it's simple, and thereafter you have all permutations and combinations, and here therefore I'll go a slightly slower. Next example is interest. And we have a very interesting scenario. Most of the companies put bank fixed deposits or give loans and earn interest. And there was a question whether this interest requires disclosure, whether there is a tax on interest. All sorts of discussions were floating around. And there was an exemption entry which said services by way of lending are exempted to the extent of interest. So therefore, a thought process is that yes, interest is an exempt supply, it needs disclosure. Whether it requires reversal or not was a debate. The government realized that this is something which is missed out, and sometime in September they amended the rules to say that interest income will not trigger an ITC reversal. We are interpreting this September amendment to be retrospective from July, so 3 months. While there is a little bit of an interpretation issue, we are suggesting that there is no requirement of ITC reversal on account of interest. So what happens is, sum and substance, interest in GSTR 3B, you will show it as an exempted supply. But when you calculate ITC reversal, you will not take it in the exempted supply column, you will ignore that transaction or ignore that value from there. So you have a scenario where you have a disclosure but no reversal. I hope I am clear of this. And more or less we have implemented this, but this is something which is a little bit complicated. Now when you look at interest, so one is you put money in a fixed deposit and you earn interest. Another is you put money in a mutual fund and you start trading in mutual funds and you earn some capital gains or profits on sale of mutual fund units. Now here the treatment is exactly the reverse. What happens is mutual funds units are treated as securities. Securities are neither goods nor services, and therefore they are not supplies, so no disclosure. Up to here it's fine. But then the ITC rule has a special rule. Just like in interest there is a special rule to not treat it as an exempted supply. For profits from mutual funds and securities including shares, there is a special rule to treat it as an exempt supply. And they have artificially said 1% of the sale price will be treated as the value of such exempted supply. And therefore, here you have a scenario, you will not make disclosures in 3B. But every month somewhere in Excel you will calculate the 1% of the traded securities and calculate it for the purposes of the expense of ratio and then reverse the credit accordingly. So you have a total jigsaw puzzle between these two. Same ocean freight like interest, treated as exempted supply, but there is a rule 45 which clearly says that there will be no reversal of credit required because of ocean freight. And then you have this whole basket of new concept which came in first with restaurants and now it has expanded itself to builders. Which is to say, we want to give a concessional tax rate and against that concessional tax rate, we will snatch away your input tax credit. So it started with restaurants where they said 5% without ITC instead of 18% with ITC. And now for builders also they have done the same thing. They have said 12% without ITC, with ITC is now reduced to 5% without ITC. Now, there are 2 or 3 important issues in both these schemes. And one question which always comes up is, when you have both the cases as a parallel, in certain cases you have restaurants with 18% with ITC and 5% without ITC. So the question which comes is, does a restaurant have a choice? Many cases, let's say a restaurant is in an airport. They pay huge lease rentals to the airport authority. So they want credits. 5% without ITC is not workable for them. So can they go in 18% with ITC is the first question which comes. The law, the way they have drafted it, they clearly are not giving you an option. They are telling you that if you are a restaurant which is not a part of a 5-star hotel, you have to follow 5% without ITC. The question is whether in a GST law they can have such type of a conditional thing which is compulsory. I think the basic principles of taxation have sometimes been given go by and this will be challenged over a period of time. As of now, a simple proposition is if you are a restaurant, you really don't have a choice. If you are a builder, you really don't have a choice. If you are doing a new project, you have to go by that 5% without ITC. If you are having an ongoing project, where you have started work before 1st of April and there is enough documentation and they have given tests for that, in that case you can choose between 12% with ITC or 5% without ITC. So depending on that, how will your treatment in the GSTR 3B come? You cannot treat this as exempted because you have to pay tax. You still have to pay 5% tax. So you show it in taxable services, but you will still claim it as an exempt activity for the purposes of ITC reversal. So here you have no disclosure, but ITC reversal. So these are the types of issues which typically come up in the outward supplies side. We can now go to the inward supplies. And inward supplies, as I was highlighting, because URD RCM is now on a back burner and officially dead because the GST Amendment Act typically removes that entire thought process only to have a blanket URD RCM. So we will not spend too much time on understanding each inward supply. I think we'll discuss it from 2 baskets. One is the RCM and vendor obligations associated with it, and thereafter we'll go into the input tax credit. So on the RCM front, 2 important changes which have come up. First is from the 1st of January 2019, wherein security services received from other than body corporates. If you receive a security service from a proprietary company or a partnership firm, in that case, you end up paying RCM, GST yourself. So again, slowly and steadily, selective type of RCM has started showing its heads over here. Most of us have implemented it to the extent possible. If you are dealing with a corporate security agency, then there's no RCM necessarily. And of course, from 1st of April, because of the new scheme of 5% no ITC for builders, you have two specific types of RCM entries coming in for builders. Both of them are for builders. The first scenario is a scenario where they want to say that TDR and FSI I want to exempt. Because as it is, I'm getting a tax on the sale of the flat. So the TDR is one of the costs for the flat. I don't want a tax on it. Up to that, fine. But if you receive OC, after receipt of OC, you are not going to pay tax. Because tax on builders is pre-OC only. Post-OC, there is no tax. Now the government does not want to leave even a single rupee in a larger scheme of affairs. So what they have told is, if a builder has purchased a development right, the seller of the development right will not pay any tax. That is very clear. But the builder who has bought the development right, at the time of OC, if he has unsold inventory with him, to the extent of unsold inventory, he will calculate the tax and pay it under RCM. Now this is a very weird scenario where I might buy a development right in 2019. My OC might come in 2023. Depending on the progress of the project, the OC might come in 2023. So in 2023, I have to pay a tax for a transaction which I did in 2019. Now this is how we are trying to, and that too proportionately. Now this is all good in logic, but when it comes to law, certain basic fundamental principles of law, can you demand a tax 4 or 5 years down the line for a transaction which got concluded 4 years ago? And these are questions which will come up before the courts, and maybe in the next 6 months or so, we will see some interesting developments on this front. The next aspect which again they try to do is this 80-20 scheme, because they don't trust anyone. And perhaps we also don't deserve that trust. The moment they say 5% without ITC, all builders will ask their contractors. When GST came, everyone asked their subcontractors to register because they didn't want to go through the URD RCM. Right? I am aware companies forced compulsorily, they set up help desks within their organizations to make each and every vendor register. On 13th October, URD RCM went away. Everybody closed their help desk. And if they were registered, they said, अरे क्यों registration रखते हो? Cancel कर दो, आपकी बीवी का नाम का bill दे दो, tax मत लगाओ. Now, this is the environment in which we are, whether we like it or not. And that's why the government needs to be cautious. If they do 5% no ITC, all builders will buy everything without bills. And therefore, they have tried to bring this very interesting thing called 80-20 scheme. And they got it only from that builder's marketing jargon, 80-20. Here you have 80-20. What does this 80-20 mean? They say that builders should purchase at least 80% from registered dealers. Their URD purchase should not be more than 20%. This has to be calculated financial year wise and for the last financial year till the time of receipt of OC. And if your URD purchase is about 20%, then on the extra about 20%, you have to pay RCM. So if you buy 23% URD, then on the 3%, please pay RCM. So far, so good. Then people ask, what is the rate? Because I might be buying hundreds of things. I might buy water, I might buy sand, I might buy steel, I might buy cement. Everything has a different rate. So what rate? 3% पे भरना है, लेकिन 3% पे क्या rate पे भरना है? Government has very easy answers for all of this. They said highest rate देख लेते हैं. So they said 18%. But then they suddenly realized that there's cement which is at 28%. हाँ, ये थोड़ा दिक्कत है. सबके ऊपर 28 मांगेंगे तो it's going to be a challenge. So say 18%. But then they made an exclusion to say, excluding cement, 18%. But cement, 28%. Then immediately the question is कि ये 3% है वो सीमेंट का है कि स्टील का है कैसे मालूम पड़ेगा? तो उन्होंने बोल दिया एक काम करते हैं ना, इतना सारा आप क्वेश्चंस मत पूछो. इतना पूछोगे तो मैं और तकलीफ ही दूंगा आपको. सीमेंट इज नॉट अ पार्ट ऑफ 20%. सीमेंट अगर 2% भी आपका URD है, ऑन द एंटायर सीमेंट यू हैव टू पे 28% RCM. And then they've given detailed annexures and illustrations. पूरा एक story book ही बनाया है, rather than a law, with n number of annexures. All of that we can just go through at some point of time. I don't think I'll take today too much time, but this is one interesting reverse charge mechanism which has come, and definitely this bypasses all general understanding of RCM and all general understanding of the law. Just a very quick cumulative checklist of RCM. We've walked this journey many times earlier, but I think it's so important that we can spend 2 minutes on this. Very quick checklist: GTA, transport. If your expenses have any of these, please make sure that you are paying RCM correctly on that. Legal services, arbitration claims, arbitral tribunal set up by you between the different parties. Sponsorship services which you pay to various companies. Services received from the government, anything which you pay to the government. Now, when I'm saying services from the government, please note that there are many exemptions also. So if it's a statutory function, then there's an exemption. So you have to be a bit careful of what all will get covered. One important recent amendment there is, even renting from government is taxable at your hands under RCM. So if you have a property which is on a long-term lease from a municipal corporation, or you are paying a ground rent to, let's say, SIDCO or MIDC or something like that, all of that will be now a subject matter of reverse charge mechanism. Directors who are not employees, there's a reverse charge mechanism. Insurance agents, etc., etc. Not too much to talk about it. Import of services, depending on the place of supply, most of the organizations are already paying taxes over there. I think the last one, I would just like to touch, which is ocean freight embedded in CIF imports. So when you import goods, if their imports are on a CIF basis, there's a freight which a foreign shipping line gets from a foreign exporter. So there's no GST, Indian GST over there, because everything happens outside India. But the goods ultimately come to India. And the freight is somewhere included in the CIF value of the goods which are coming into India. Government is greedy. They don't want to lose this tax on this embedded freight, ocean freight. And therefore, there is a provision which requires you to pay reverse charge mechanism. As an importer, you have to pay the tax on this. Wherever you have a CIF import made by you, you are required to pay a GST on this. Earlier also, there was a service tax on this. Matters are pending in the courts whether this can really be demanded at all. But right now, the law is there. Better to pay tax and claim credit rather than go into a long litigation zone. Few other variations of vendors' obligations. There is a section 9.5 where certain types of e-commerce operators, certain types I would say, are expected to pay the tax on behalf of the underlying suppliers. And the best example is your radio taxi. You have all these Ubers and Olas of the world. So that's an e-commerce operator. The actual taxi operator will be a very ground level person who will not be registered also. So the tax on that supply has to be paid by the Ola or the Uber. Same thing they've done for accommodation services if the hotel is unregistered. Similarly, housekeeping services provided by unregistered vendors. Again, you have an e-commerce operator who is deemed to be the supplier and is required to pay the full tax. Now, this is notified e-commerce operator. This is a bit different from the provisions of tax collection at source, which is applicable across the board to all e-commerce operators like Amazons and the Flipkarts of the world. Now, that also has been made effective from October 18, where we are told that if you're making any supplies through an e-commerce operator, online portal or maybe an app or something like that, and payments are also collected by that app or that online portal, in that scenario, TCS will be effected at 0.5% C and S, because now we have two variations. So total 1% effective tax on the net value of taxable supplies. Now this net value means net value after reductions or on account of rejections and returns, goods returns. And supplier will get the credit of this TCS. So the e-commerce operator will collect this tax from the supplier when he makes the payment, and he will claim the credit in the cash ledger. Same thing for TDS. If you are dealing with government contracts, then government or semi-government bodies and government companies, public sector banks, all of them are defined as notified set of payers who will be required to deduct TDS at the rate of 2% of the gross amount. And again, this will come in your cash ledger as a TDS credit. You have to each month check and pick up and tick the respective persons and own up that credit or reject the credit. And accordingly, once it comes into your cash ledger, you can adjust it for payment of your normal taxes. And if there's an extra balance in your cash ledger for whatever reason, you can even file a refund claim for that. So these are some other variations of vendor obligations. And now I take you through an important topic, which is input tax credit. It's an evergreen topic. we always talk about the basic conditions for the claim of the credit, and they typically include that you have to receive the goods and services. There is a list of blocked credit or ineligible credit. It shouldn't be listed within that ineligible credit list. You should receive a valid tax invoice. The vendor should have paid the tax. And in the implementation meetings, we already talked about saying that the vendor should have uploaded the tax to your customer's account, which is your GSTR 2A. Of course, this matching concept right now is in abeyance, and we have a detailed slide where we'll talk about the ramifications of 2A versus 3B mismatch and things like that. But before we go into that, let's quickly look at the block credit. And here also you'll find some action happening in the month of February. And the first major amendment which has happened is that the credit in relation to motor car services have been disallowed. So earlier we had a disallowance of credit for purchase of motor car. But if you have a motor car insurance or a motor car repair, we believed that the credit was available. There was a group of people who believed it is not available, but we believed that the credit was available and we were claiming those credits. But in February, this third entry has come, wherein we are told that services in relation with such motor vehicles will not be eligible for credit. So if you are claiming motor car insurance or motor car repairs credits, now you will not be eligible for that. And so you have to be a bit careful about it. One positive side of it is they have said that motor vehicles will be only capacity below 12. So if you have a bus which is used for transportation, many a times if you are a call center or something like that, you will have mini buses and buses which you are using for staff transportation and things like that. On that, the credit is now available, which was earlier not available, now becomes available. Of course, vessels and aircrafts for self-use not available as a credit. If you are rich enough to have your own private jet, you have to be a little bit careful. No credits will be available to you. Rent-a-cab, food and beverages, employee-related services like Mediclaim and all of this has been always not available as a credit, so not much to talk about. We do receive a lot of queries on the next point, which is construction-related services. And here the block credit has, we always say 2-3 important things which you have to check. What is not available as a credit is something which is immovable, which is capitalized in your books of accounts, and which is not plant and machinery, will not be available as a credit. So if you are getting a factory constructed, necessarily you will capitalize it in your books of accounts. The factory building by itself is not plant and machinery, and the factory building is immovable, so you will not be eligible for credit. Now, in the context of services and in corporate offices, many times questions come up is we get renovation done in our office. And then you have a long list of items which you spend on. And then you ask questions whether this is available as credit or not. So again, you go back to these 3 tests. You have put up a central air conditioning plant. That's plant and machinery. Credit available. So just check these 3 things. Immovable, plant and machinery, capitalization. अगर ये तीनों चीज होती है, उस हिसाब से you decide the credit eligibility. So if it's plant and machinery, air conditioning unit, firefighting unit, if you set up an escalator within your building, all those things, credits are clearly available. Second thing is furnitures. You buy chairs, you buy tables. They are not immovable at all. If they are not immovable, credits are available. Right? And third is expense off. Many a times if the expense is not big, you may not capitalize it. You might just write it off as a repair in your P&L account. If you are writing it off as a repairs in P&L account, again, credit will be available. So just use these 3 benchmarks and try to find answers. Wherever you have doubts, you can always come back to us and we'll give you a detailed analysis of that. But this is what I think is important because this is very frequently coming up as a question. Goods and services for personal consumption not available as a credit. Also, we need to make sure that personal consumption is not debited to the P&L account, especially if it's a company. Because in company, there's an assertion that no personal expenditure is debited to the company account. Last one is a little bit tricky. Goods lost, stolen, destroyed, written off, disposed of by way of gift or free samples. And this is where the officers will get what you can say a legroom to verify your inventory records. And check whether in your inventory records everything is moved out by way of a sale or a commercial transaction, or do you have transactions like this. And maybe some of these may not appear in your P&L in any manner. It will be just an entry in your inventory records which says I had, let's say, 20 bottles of Bisleri and suddenly I find 15. So I'll just reduce my stock by 5. But there will be no entry in books. It will be just an inventory adjustment. Now these types of inventory adjustments is something which will be susceptible to some review at some point of time. This we've talked too many times. GSTR 2A, the credits flow from vendors. We look at our books of accounts, do a match, and then when you do a match, there is something in 2A but not in your books, something in books but not in your 2A. What to do about all of that. So this is just a small checklist on that. Details will come to a bit later. Of course, when you look at ITC, typically we'll divide that input tax credit into 3 baskets. Credits which are clearly eligible. Again, I could divide this into common and specific, but for simplicity, let's keep it at eligible. Credits which are ineligible, the block credits which we talked about. And finally, there are certain reasons where you will require reversals of credit which have been taken by you. Because the law requires you to make the payment within 180 days. If you don't make the payment within 180 days, then there's a reversal. That reversal is temporary because you will get a recredit when you actually make the payment. So therefore, I have classified it into temporary. Same way, there's a law which says that if the credits don't match, you have to reverse the provisional credit. And when the vendor uploads it into your 2A, you can reclaim the credit. Please note, this is right now in abeyance, but yes, it is there in the sections. As far as permanent reversals are concerned, you can have a vendor giving you a credit note with a tax impact. Necessarily, this will result in a reversal of credit at your end. Suddenly, sometimes you might so happen that you might have claimed a credit at the first instance. Let's say Mediclaim credit. Ideally, you can't claim, but you by mistake claimed it, and after 1 month you realized it. So you will reverse it. So certain credit which was originally ineligible but claimed, later on found to be ineligible and therefore reversed. And finally, you have this big demon of Rule 42, which requires you to calculate a ratio of taxable to exempt supplies and then reverse a credit equivalent to the exempt supplies. So these are some types of reversals which come into play. And interestingly, when you look at all these reversals, there is a concept of interest which also comes into picture. And there are varying rules about interest and varying interpretations of interest. So we'll just take one slide looking at what happens on the interest front on these ITC reversals and other transactions. Now, when you look at the law, one thing which is very clear is if there's a delayed payment of tax, there's a clear provision under section 50, subsection 1, which says you pay an 18% interest. But this is for delayed payment of tax. Let us say I have to pay a tax of 100 rupees, which is due on the 20th of April, because March ka tax is due on 20th of April. But I don't pay on 20th April, I pay on 25th of April. So for that 5 days, I have to pay interest at the rate of 18%. Up to that, it's very clear. But within this clarity, the way the GST law has been implemented, there are problems. Let us take a scenario that I have a credit balance in my electronic credit ledger of 100 rupees. My tax due for March is 100. But instead of 20th April when I have to file the GSTR 3B, for various reasons I do not file it and I file it on 25th of April. Am I required to pay interest? That's a question which comes. Because I'm not paying any tax. Tax I will use from that credit ledger. So am I required to pay interest or not? And this is where when we start telling clients that you have to pay interest, many clients tell me, excuse me, interest is a tail of tax. You're not asking me to pay tax, but you're asking me to pay interest. How does it work? This is a common question, and this had resulted in lots of difficulties, and especially in the initial months when the portal itself was not working well, and people were not able to offset taxes and things like that. So GST Council actually thought about this issue, and there's a press release in the month of December on this point, wherein they have said that interest will apply only if there's an actual tax outflow. If there's only a delayed offset or if there's a credit balance, interest will not apply. There's a press release. Unluckily, press release is not followed either by a law amendment or by a portal amendment. And therefore, our office will still ask you to pay interest despite this press release. If the interest is big and you are in a mood to fight all the way to the courts, then it's a separate story. You can rely on the press release and say, look, this press release is there. The governments have not done act. They just keep on talking, not doing things. And in the election season, we always talk about things of talking versus actually doing. So press release is nothing but talking. So this is something which one can always look at. But yes, this is something which we need to bear in mind. Now, going to the actual scenarios of credits and reversals, certain specific provisions are there. So if you have a proportionate reversal of credit on account of expense of ratio, you are told that you will pay an interest at 18% from the start of the financial year till the day you actually do the reversal. So start of the next financial year. So for the year 17-18, from 1st April 18, you will start the interest meter. And you will pay it all the way till you finalize your expense of ratio and reverse it from your credit ledger. So 2 months, 3 months, whatever time it takes, you will pay the interest for that period. Reversal on account of non-payment within 180 days, and this is really unjust. You will start paying interest from the day you actually took the credit till the date of reversal on the 180th day, again 18%. Reversal consequent to mismatch, 24%, but this, of course, as I was told you, the law itself is in abeyance right now. Then you have two interesting scenarios. One is reversal of transition credit, and in the next slide we'll be talking about transition credits and the ill fate which KKC got because of that. Initially credit was eligible and then they made a retrospective amendment to deny the credit. We'll talk about it. In those cases, whether interest is payable. When you reverse transition credit, which has been wrongly claimed, or which you are reversing because you don't want litigation. According to us, there is no provision in the law requiring you to pay interest. The department interprets this 24% to be covering these cases also. And therefore, typically the officers will ask you to pay 24%. If the amount is big, or if the officer is not insisting on interest, we are not on our own suggesting you start by paying interest. Okay. Depending on the issues raised by the officer, somewhere depending on the amounts, we might decide to pay interest. Same thing applies for wrong availment of credit, which is reversed later before utilization. Again, credit note related reversals, again, there cannot be any interest. So these are the scenarios of interest. Now comes something new again. They did something. There was a problem of IGST settlement. The governments didn't know how to settle the accounts amongst their different states. And therefore, they amended the law. They amended the law, but the portal didn't get amended. Therefore, they realized that now this is also not working and industry also has problems. So again, they amended the law. So you have three versions. Old version, something which was there from February to March, but never implemented. And something which is there from March. So I'll not talk something which is in between, because unnecessarily you'll get confused with all the versions. We'll talk about the first one and the third one. First one, all of us are clear. We had these baskets which we used to talk about. First, you adjust like against like, CGST credit against CGST output, I against I, S against S. After adjusting individual baskets, if there's a surplus, I can go into C and S. If there is in C, it can go to I, S can go to I. But C can't go to S, and S can't go to C. And we always understood C can't go to S, S can't go to C, and otherwise everything is more or less free to go anywhere they want. Now, when it comes to, when this was there, government found that there is a lot of people who had a lot of IGST credit lying. Now, essentially, IGST kiska paisa hai? CGST central government ka hai. SGST is of that state. But IGST is like your POK in today's language. Nobody knows whose money it is. Right? So now they can't, that was just growing in terms of balances. Now who enjoys that money? And therefore they wanted to make sure that IGST ka closing balance is jitna ho, kam ho, zero ho. So what they have done is the new fungibility rules gives a forcible rule to adjust all your IGST first. They say you start with IGST and use it for IGST first. Initially they had said after that use it for C and then for S. That's the February-March period. But then better sense prevailed. They said after you exhaust IGST credit for IGST output, you can use balance IGST credit for either C or S, but please exhaust it. या तो C में या तो S में कहाँ करना है आप करो. आपको S में ज़्यादा करना है S में ज़्यादा करो, C में ज़्यादा करना है C में ज़्यादा करो, लेकिन करो. My practical advice to you would be adjust it in a manner that as far as possible the closing balances of CGST and SGST are somewhat nearby each other. If you have CGST of 1 crore and SGST balance of 10 lakhs, try to adjust the CGST first and SGST later. Because C and S abhi bhi takrane dete nahi hai wo log. You cannot use C against S, S against C. So whichever has a higher balance, try to exhaust that first and accordingly plan your activities. They have now given you a choice of choosing C or S or partially C, partially S. But use it wisely. Each month, depending on your facts of the case, you may need to change. After doing all this, after emptying the bucket of IGST credit, then only you will go to C against C, then only you will go to S against S, and thereafter if there's something in C, you can use for I. If there's something in S, you can use for I. Definitely, the old thing of C not against S, S not against C continues. So this is the new theory after March, which they have tried to bring in on fungibility. Now, we go to some important aspects, having understood the broad developments of the law, how all of this translates into your documents, into your filings and all of that. Let's try to understand that from the way the GST law has been implemented till date. And as we all know, till date we have these 5 documents which are regularly used. You have your GSTR 1, which is your statement of outward supplies. GSTR 2A, which is an auto-populated statement of inward supplies. You have a 3B, which is a summary level data of your tax payments and your tax liabilities. 9 is a summary of your monthly GSTR 3Bs filed with impact of subsequent amendments and certain statistical information. And to a large extent, GSTR 9 is available in an auto-populated manner on your portal itself. You just need to verify those numbers, and if required, you can change those numbers and then get it filed. But of course, if you are into audit, make sure that 9 and 9C go together, because 9C is basically your reconciliation of your GSTR 9 with the financial statements and the books of accounts. So these are the 5 broad documents. And the contents of that, of course, I don't think we'll spend too much time onto this. We will email the presentation tomorrow so that you can use it for a regular usage purposes. Most of these returns you must be filing or getting it filed, so you must be aware of the columns for that, the B2B, B2C, amendments, all those things. I don't think we'll spend time on that. We are a little bit behind schedule, so I'll not take too much time on that. But yes, each of them has certain interlinkages with each other. But when you look at GSTR 2A, that somewhere comes out as a dangling piece of document. And uska role kya hai, that is not really very, very clear. Especially because various matching principles are kept into abeyance, and what we believe will come to in a subsequent slide when we take it up. But before we go on to that, one important thing which has happened is, earlier the law said that anything pertaining to a financial year, let it be the claim of the credit, let it be a credit note, or let it be an amendment to any transaction which you have uploaded, all of that should be completed by September, because there has to be some closure to an exercise. So a financial year, things will get closed by the September. Now this year, September, lots of people could not do many things, and therefore government, as a concession, not in September, after September, somewhere in the end of October, after everybody had done all the rigmarole, they extended this September date to March. And therefore, a fresh lease has opened up. Anything which has happened as an error in financial year 17-18, you still have March 19th return where you can rectify it. Of course, we have been telling clients, and many of them have diligently identified small errors and rectified them in the GSTR 1s and 3Bs. But yet, if something is left, I think March 19 is the last recourse for those amendments, and therefore this thing we had done in our earlier discussions in this forum. But I'll just quickly take you through that, because there's already 6 months and sometimes memories go a little bit haywire. So we'll quickly take a look at what are the types of commonplace errors and how you could rectify them. And I think the first error which happens is in GSTR 1. You have wrongly reported a B2B transaction as a B2C. I think this is very easily amendable. Reduce the B2C value and upload the invoice as a B2B separately. Once you do that, the plus tax and the minus tax on account of B2C amendment, both of them will nullify each other, and the corrective action will not result in any tax liability at your end, and the customer will clearly get a credit in his 2A. So this actually closes the loop in a correct manner. As far as, and everything we'll discuss it in 2 manners. What is the way in which you'll correct it, and what happens if you miss this bus? You already missed the first bus. Government has given you an extension of 6 months. Now, what if you again miss the bus? Because in organizations, volumes may be huge, and it may not be possible to make sure that everything happens. So what happens if you again miss the bus? In that case, I would believe, as far as the supplier is concerned, he has disclosed the turnover, he has paid the tax. It's only that he has not uploaded it in the right column. At the most, it's a small inaccurate reporting. I don't see a major concern at the supplier end. But at the customer end, because it has gone in B2C, the credit will not get reflected in GSTR 2A. A very common example here is banks. Typically, if you are dealing with a bank and you had given GST number to the bank, but bank guy didn't put it in the system, Or let's say travel company didn't put it in the system for an air travel bill. Telephone companies didn't put it in the first few months. So your bill, Vodafone has uploaded as B2C. But actually it is B2B because it's a business expenditure for you. Now in these scenarios, Vodafone को तो कुछ नहीं होगा, उसने तो tax भर दिया है. As far as you are concerned, the credit is not coming in your GSTR 2A as a customer. Question is whether you can get the credit, especially considering the fact that the matching process is not available. I would believe that there is a good case to say that the credit should be available. The only stumbling block which I see is the proviso to Rule 36, which says that for claiming credit, you have to have a valid tax invoice. And that valid tax invoice should contain certain particulars, and one of the particulars is GST number of the recipient. Now, typically, that Vodafone bill doesn't have your GST number. And therefore, an officer can say, under Rule 36, the document is a defective document, and you cannot claim credit on a defective document. I have clients here who are in the manufacturing space and were working with excise department, and they know how excise department can, at times create problems. If you have XYZ Enterprise and you get a bill in the name of XYZ Enterprises, one S extra return, we've seen that name does not match, credit will not be allowed. So, and they said this document is defective, so I'll not give credit. Address में plot number 12 के बदले किसी ने plot number 13 लिख दिया. I don't know whether goods have come to your plot or not, I'll not give you credit. Excise में we've seen all those cases. Matters have gone to the courts. Courts have said that these are procedural defects, and procedural defects cannot result in denial of credits. I think that same route will have to happen here. The officer will say, आपका GST number नहीं है, Rule 36 satisfy नहीं हुआ, I am not giving you credit. You will have to fight it out, and then you will have to say that, look, this is my genuine business expenditure, this is a check through which I made the payment, this is my expenditure, I have the bill, and the person has paid the tax, so please give me credit. And courts will have to look at it leniently. But that's a long exercise which you will have to go through for this process. B2B, reported in B2B but wrong GST number. Again, amendment in table 9 is possible up to the 11th of April because March return of GSTR 1 will be due by that time. Thereafter, again, supplier, there's no issue. At the customer level, there is a problem. Credit is not reflected. Again, the actual customer who is entitled for credit can continue the same lines of argument like Vodafone's example. Here, it's very likely that the error was done by the supplier. And if the supplier has done the error, one more argument could be, I could not be penalized for no fault of mine, for the fault of the supplier. So that is one more line of argument which can happen. Now, what happens in the case of the customer whose wrong GST number is mentioned? So the credit should have gone to one Mr. A, instead of that it has gone to one Mr. B. Can Mr. B claim the credit because it's appearing in his 2A? And answer is clearly no. The conditions of the claim of ITC are not satisfied. He neither has an invoice nor has he received the goods and services, so the credit cannot be claimed by him. Wrong POS but correct tax, we talked about it. This is again going to be something where there will be litigation. At ground level, officers will say, I will not give you credit because the tax has gone to some other POS. And you will say that the law doesn't have any provision to disallow credit because of a wrong POS. So this is something which will be an issue again at a litigation forum. Each of these, depending on the materiality, you will take care of whether you want to litigate or not. But before you go into litigation, one simple advice is, if you know that these things have happened, please get it amended before the 11th of April. So SEZ tagging, I think this is more or less now rectified, and the systems are also streamlined onto each of these effect. As far as GSTR 3B is concerned, this is a summary level document. So whatever variations between your GSTR 1 and 3B, make sure that the cumulative effect of that in the March 2019, the impact has been given. And of course, now they are started sending you notices if there's a mismatch between the values in GSTR 1 and 3B. So please make sure that you do it in the right manner. This brings me to one point which I have deferred 2-3 times our discussion. What happens to a credit which you have claimed on a valid invoice in your 3B, but the vendor has not reported it in your 2A because he has not filed the return, because he has run away with the money or whatever. Now, what is the legal proposition? The legal provisions are that Section 16(2) requires payment of tax by the vendor. This payment of tax can be demonstrated by n number of mechanisms. It need not be only through an upload in your 2A. You can give the challan, you can take a CA certificate, you can find out n number of mechanisms through which you can ensure that the vendor has paid the tax. Section 42 had this matching process of 2A coming in. This entire matching process is in abeyance. And interestingly, in September, when this entire issue was raked up, there's a press release in September which through various things, inter alia says, the apprehension that ITC can be availed only on the basis of reconciliation is unfounded. This is the press release of the CBC. As the same exercise can be done later also. Now this I think is very clear. It doesn't say that just because there is a mismatch, you will not claim the credit. Only thing is they have kept it open-ended. They have said, as the said exercise can be done later. Later means when? 6 months, 1 year, 2 years. They have not given any time frame for it. And therefore, I would assume that a logical time frame would be your assessment. 3 years down the line, 4 years down the line, when your adjudication or the assessment happens, till that time, if your reconciliation happens, life should be okay. I don't think there's an immediate need to reverse some credit because it's in your books but not on 2A. Credits in 2A but not in books. Necessarily because it's not in your books, you are not claimed in 3B and you are not claimed the credit. But here, there is a provision which says that the credit has to be claimed before March 19. Now, there are two scenarios here. Vendor has wrongly uploaded the credit into your account, in which case you should not claim the credit. Or vendor has rightly uploaded the credit into your account, he has sent you an invoice, but somewhere your purchase department or your processing department has not processed the payment, and therefore it has not appeared in your books of accounts. Now that credit, if you want to claim, you have to claim by March 19. So ideally, like when service tax transitioned to GST, we made people check everyone's drawers and find out all pending invoices and got them accounted in the books in June 17. I think a similar exercise every year we have to do. Now, if that is not feasible, a simpler solution is claim the credit and on the same day reverse it. We had suggested this exercise in September. If you have done it, it's fine. If you have not done it, we suggest that you do it in March. Find out this value, claim the credit in the month of March, same day reverse it, because moment you reverse it, it is effectively not taken. But at the same time you had taken, so your time limit you have satisfied. Later on, when you actually book that invoice, maybe 3 months or 6 months down the line, you can claim the recredit. Because recredit, there is no timeline. The timeline is only for the first claim of credit. So that is something which you have to be, if you want, and the amounts are big, you can do. The last point on the reconciliation aspect is multiple GSTNs. And here you have various scenarios that your credit for Maharashtra, instead of Maharashtra, is appearing in Gujarat. So if you are a multi-state company and you have a mismatch report, one more step which you have to do is that mismatch report should then be matched across states, to see that one mismatch in one state does not get compensated by another mismatch in another state. And if that happens, then identify corrective action. Otherwise, there can be a possibility of a double effect also. Transition credits we talked about, there is a requirement for reversal of KKC because of the retrospective amendment in the GST Act. Interest liability, we discussed, it is debatable clearly because there is no clear provision requiring a specific interest payment, especially on transition credit. So one can really argue that interest is not payable on this. GSTR 9, I think more or less we have done it earlier, and so we'll not spend too much time. Two important changes which have been done here is that earlier they were just talking about summation of GSTR 3B and the values disclosed in 3B. But now the verbiage is a bit changed, and they are now saying details of supplies made during the financial year. So here, now they are talking about determination. Earlier it was just a summary or a consolidation. Now you can actually take your financials, take the actual value of your supplies and plot it over here. There can be two scenarios. In 3B, your turnover is less than the turnover in your actual books and therefore in GSTR 9. If that be the case, differential tax you can pay by DRC 03, and once you pay that tax, that gives you an opportunity to come clean of certain transactions which you missed out in paying. So one change which has happened here in the annual return is basically to say that you can now disclose additional turnover because of this reason. You can determine the turnover, disclose the extra turnover which you had missed in your regular returns, and pay the taxes through DRC 03. And once you pay those taxes, life should be reasonably comfortable. Second scenario which can happen is you had paid more taxes in your returns, but in your annual return in your books, the amount is less. Now this is something which is a little bit of a challenge, because once the taxes have been debited into your GSTR 3B, there is no mechanism to take it back as a recredit in your GSTR 3B. So if you have paid more taxes, then that's lost. There's no mechanism to get a refund on that account. So it's both the ways you are at a loss in that scenario. So that is one important thing which in this form becomes important. Quickly running through it, 4 is basically your details of your outward supplies and inward supplies on which you are required to pay tax under RCM. So this again has been divided into B2C, then you have B2B, all of them coming from certain tables from your GSTR 1 and 3B. Then you have your zero rated supplies on payments of taxes and SEZ supplies on payment of taxes, advances on which tax is payable, and RCM taxes. And thereafter there are adjustments on account of credit notes and debit notes, and supplies declared or tax declared through amendments, both positive as well as negative. Second is tax transactions on which no tax is payable, which is our export without payment of tax, SEZs without payment of tax, tax on which RCM is payable by the recipient, exempted, nil rated and non-GST supplies, and the net effect of credit notes, debit notes and amendments on these accounts, which will ultimately give you a total turnover determined for the year, which unluckily this turnover includes RCM also. So you have to remove that RCM to match it with your financials. Thereafter, you have table 6 which talks about the input tax credit, and here the first challenge which comes is your subclause B requires the classification of input credits into inputs, capital goods and input services. What happened was, while these 3 definitions are existing in the GST Act, the credit are instantaneously available in all the 3 cases. And therefore, most of the organizations have not created systems whereby they are able to separate inputs, input services and capital goods. Our suggestion to them is look at the HSN code, because your services come with your HSN code starting with 99, and therefore whatever HSN code comes from 99, take it into input services. Balance HSN code, then see whether it is a balance sheet item or a P&L item, basically account code, GL code leke, and then identify inputs and capital goods accordingly. But yeah, this is an exercise, and we always make sure that there's enough employment generation in the accounting space. So I don't know why they want this information, but suddenly they have demanded this information, resulting in a little bit of a calculation which needs to be done at each organizational level. So all of these, you have different baskets here. Inward supplies from a URD where RCM is applicable, RD where RCM is applicable, import of goods again classified into inputs and capital goods, and then import of services, and then ISD, and then you have your reclaim of credit already reversed. So as we saw, there are certain situations where there are temporary reversals of credits, like 180-day payment, mismatched credits. So in those cases, you claim credit, reverse credit, and then reclaim the credit. That reclaiming of the credit will have to be disclosed here in column H. And thereafter, you have your total, and then you find a difference of this, identify the transition credits, put it over here, and then talk about various reversals which you have done. It can be either on account of payment not made within 180 days, or distribution of credits by an ISD, expense of ratio, rule 42, and then capital goods expense of ratio. It's a demon in itself. Some other day we'll talk in detail about it. Rule 43. And then you have block credits, your motor cars and mediclaims and all, which is your section 17.5. If you claim Tran 1, Tran 2 and your officer has forced you to reverse something, then that comes here as reversals of Tran 1, Tran 2 credits. And then if you have made any errors or contra entries which requires reversals and it's not in any of these rules, it will come in your column H, which is other reversals. Now comes certain statistical information. And this is where, for the first time, GSTR 2A comes into picture. So here you are told, find the ITC as per GSTR 2A and find the total of ITC as per our earlier discussions, and then include the RCMs and other things and find the difference. Now this difference, they are saying, will get lapsed. They are very clear on this. At some other, in column K, after going through this entire rigmarole, you will end up with a very categoric statement which says, this is my ITC which is lapsing, which is basically something which is in your 2A but not in your books, will get lapsed. So that is a very categoric, and it's very clear in the law also that it will get lapsed. So that takes me to the taxes paid, just a summation of all the taxes that you paid through your returns, through cash and paid through ITC. Both the columns are clearly available over here. And thereafter you have next part which comes is previous year's transactions declared in the current year. All of that, the differential tax and the calculations will come through this area over here. And thereafter certain information about refunds claimed and rejected and demands raised and paid. So unpaid demands also comes out over here. Supplies from composition dealers, deemed supplies under job work, section 143. Goods sent on approval basis not returned within 6 months, all of that has to be disclosed here and the taxes have to be paid. Part 6 is something wherein there was a lot of debate. They are requiring information of all your outward supplies and inward supplies, HSN code-wise, including quantities. Now, this was where it was really difficult because initially in the GST returns, they had said we will want this. Then they had done away with that. So people didn't really pay too much attention to this. And suddenly when GSTR 9 comes, we find that we are required to give all these HSN-wise details. And again, their classification is there that up to 1.5 crores, it is optional. Above 5 crores, you have to supply a 4-digit level HSN information. After a lot of furor, what the government has done is they have taken an in-principle decision that you are required to disclose information for important items where the value is more than 10% of the total value. So if your total purchases during the year, including expenses, is 100 crores, only items where the value is above 10 crores needs to be disclosed. So typically, if you know your principal raw materials, principal inputs, and find that value and put it that over here, I think it should be able to handle it. And I think that is not very difficult in that sense, because each company will know there are 5, 6, or 10 important principal inputs which they have. And necessarily, those HSN codes and those values they would have. So shouldn't be that big a problem over here. Finally, if you have paid any late fees, that comes here. And then there's a declaration that whatever you have done is true and correct. And then you have to digitally sign it and upload it. So that is as far as the annual return is concerned. GST audit report, of course, we've walked a lot of journey. The 4 steps, quite a few of us have completed those steps. Audit engagement, preparation for audit. And we are already at the audit execution stage in many of the clients. If you are lacking behind, if you are, please identify the first 2 steps immediately, because June is a due date for the GST audit. If your turnover exceeds 2 crores, then you are required to get your GST audit done in Form 9C. As far as execution of audit is concerned, we've started reviewing the positions and verification of data and taking corrective actions therefore. Ultimately will result in the filing of the audit report, and then necessarily those corrective actions and the systems changes will come up in that direction. As far as the audit report is concerned, there are 2 different specific formats. We'll not go into detail depending on whether we have done your statutory audit or not. Either format 1 or format 2 will be applicable, and we'll make sure that we choose the right format. Along with the format which has certain assertions, the key information comes in reconciliation statement. And that reconciliation statement has 5 big tables. The first table is, of course, the basic details. And thereafter, there are 3 different types of reconciliations, and resulting in finally a recommendation. There's a reconciliation of turnover, there's a reconciliation of tax, and there's a reconciliation of ITC. So these 3 reconciliations is going to be the core of this entire GST audit exercise, finally resulting in some recommendation of additional tax liability. Please note, we are empowered only to recommend additional tax liability. Though we would have loved to, we are not allowed the power to recommend refunds. Okay, so again, a one-way street. If there's a deficiency of tax paid, we will recommend you a payment. If there's an excess, we will just close our eyes, because the format does not permit us to recommend claiming a refund. Let's go to a simple example of a reconciliation. A Limited has raised an invoice of 1 lakh to B in August 17. Amount was wrongly uploaded as 10 lakhs in GSTR 1, 3B and up to 9 also. No corrective action has been taken. Ideally, they should correct it from 10 lakhs to 1 lakh. Life goes simple, there's no reconciliation. But now, they have not done anything. Therefore, you end up in a scenario where the financial turnover is 5 crores. But because that 1 lakh became 10 lakhs in one of the invoices, the GST has been paid on 5 crore 9 lakhs. Now, there are 2 things which we need to bear in mind. The first thing is, after March is over, we are assuming March is over, and they didn't do anything in that. Please reconcile to the fact that the tax on this 9 lakh is lost. That is the first important step. Now it's only how to put it in our reports is what we are going to discuss. One thing is very clear, the tax on 9 lakhs is lost. So how will you go about it? You have a financials which says a turnover of 5 crores. Your GSTR 9 has a turnover of 5.09 crores because it's a consolidation of 3B. So the system will propose 5.09 crores. One method is to say, this 9 lakhs is an audit adjustment in Form 9C. And we say that this is a wrongly reported turnover twice, and which increases the value on which tax has been paid. Or the second scenario is you change the annual return to 5 crores itself. And then the audit report just says there is no reconciliation. But at the same time, the refund which is there is no mechanism to show any refund. So there will still be a mismatch between your 3B and your GSTR 9. which at the time of assessment will need to be explained. So depending on how you want to deal with it, I think there's a little bit of a window. You can do the rectification in GSTR 9 or in GSTR 9C, whichever ways you want to do it. Now what are the clauses in the GSTR 9C? You start with the turnover. Now as far as multi-state companies are concerned, we typically start with an insistence on a state level trial balance. If that is not available, at least a state level profit and loss account definitely becomes a starting point. If that state level trial balance or a profit and loss account is statutory, audited or certified, it would be well and good. Otherwise, we'll definitely require at least a management certification on the state level financials. That would be the starting point of our discussion. And that turnover, the sales figure in that would become the starting point on the basis of which we will go ahead with the reconciliation. Of course, there could be additional items which you will take into account as add-less adjustments, and they would typically include your other incomes, they would include your branch transfers, they will include your sale of assets, etc., etc. Some typical challenges we might find in cases like builders, developers, or commission agents where your P&L discloses a totally different figure as compared to your invoicing. But I think those we will take up individually as and when it comes. To the turnover, as per your financials, you will have to adjust it for unbilled revenue at the beginning of the financial year and at the end of the financial year, because these are not billed revenues. Subject to the time of supply rules, you don't need to pay tax on such types of unbilled revenues, and therefore there are adjustments under clauses 5B and 5H on this effect. Similarly, if there are advances, you are required to pay tax on advances. So clauses 5C and 5I talk about adjustments on account of advances at the end of the financial year and at the beginning of the financial year. Now, when we are talking about advances, 2 or 3 things which become important is, from a particular date, advances for goods become not liable for GST. And therefore, if advances for goods are received, we will not report it here. Many companies do not pay taxes on advances on services, especially when you look at the hotels and all. It's very difficult for them to pay tax at the time of banquet booking because it might last for a year, 2 years, and so on. In that case, we'll take a position that these are more in the nature of a refundable deposit, and therefore tax is not payable. So that is, depending on that, reporting over here will change slightly. If you are paying taxes on advances, then only these clauses will have an impact. If you are not paying taxes on advances, then it will not have an impact here. Maybe there will be a small note somewhere in the body of the report explaining the reasons why taxes have not been discharged on such advances. Clause 5D talks about branch transfers. We've already discussed the scope of branch transfers, goods, services. Whatever are branch transfers, because they get nullified in your financials, you have to add them over here for the purposes of calculation of your turnover in the reconciliation. Discounts which are given subsequently, all of them will require adjustments, and those adjustments will come up over here in clauses 5F, 5J, and 5E. And of course, all these conditions we've talked about at the earlier forum, so we'll not again go into detail. This being a unique year where the GST was implemented from the middle of the year, we will have April to June turnover being disclosed separately, taken out, because that would have gone under the VAT or the service tax regime, and therefore no GST payable on that transactions. Adjustments on account of supply of goods by SEZ units to DTA, because the DTA will pay tax as an import, will come out over here. If partial period you have been under composition, that amount will come up under 5L. And thereafter, valuation related adjustments will come up in 5M and 5N. Maybe foreign currency fluctuations or any out-of-pocket expenses on which you are paying taxes will come up in 5M. And then you have other adjustments wherein you can have n number of different things which kahin bhi nahi baitha, to 5O other adjustments is there which will take care of those types of adjustments. So that explains broadly the turnover reconciliation. Now you go into the 7th one, which is turnover reconciliation in terms of exempted activities, zero-rated supplies, and RCM supplies. After you remove all of this, you will end up with a turnover on which tax is payable, and then you will go ahead to reconcile taxes, both outward taxes and RCM. You will compare the tax paid as per annual return with the taxes payable as per the disclosed turnover, and if there is an unreconciled tax, it will be advised for payment. And that takes me to ITC, and when you go to ITC, there are 2 important clauses, clauses 12 and clause 14. Clause 12 is primarily a macro level reconciliation of ITC as per financial books and as per the annual return. So you have adjustments on account of prior period adjustments, including transition credits, and thereafter you just compare it with your annual return, and then gives you a figure of unreconciled ITC, which will be advised for payment. And clause 14 goes into expense-wise summary of ITC, and it requires us to observe whether the ITC is correctly claimed or not correctly claimed. So wherever there is an ineligible ITC, we will have to report it in clause 14 and again advise for a payment. This will result in a summary of recommendations wherein we will have to recommend short payment of tax liabilities, excess claim of ITC, wrong claim of ineligible ITC. Also, we have to report any interest, late fees or penalties which are payable. And if there is any other amount paid for supplies not included in annual returns, that also we will have to identify. If you wrongly claimed refunds, we have to identify that and tell that, yes, these are wrongly claimed refunds, please pay back. If there's any outstanding demand to be settled, we'll have to identify that also. But as I was highlighting, there is no scope for advising any refund or advising any reduction in the payment of the taxes. So this is the GSTR 9C. This being the first year, it's going to be very critical that this is handled in a appropriate manner. And therefore, of course, now we will outreach, and we already started doing that. And we'll have to now, in the next month or two, when we are in the election tempo, we are in the vacation mood in the month of May, we can also simultaneously prioritize this as an activity so that we don't have a lot of rush on the last day in the month of June. That takes me to the next important facet, which is the proposed new return format from the month of July. So this government has some fascination for July. Many things they want to do from July. And this also is now proposed from July. And while it has not received too much attention because people feel that, ये तो ठीक है ना, वो एक आध छोटा मोटा change होगा. But that छोटा मोटा change is likely to result in a big systems and an accounting change. And therefore, we need to be a little bit careful about this new return format, especially if your organization is complex, if you are on a software which is a complex software like an ERP, please take this document seriously. I know it's not effective. Initially, they had said that they'll make it optional from April and compulsory from July. Then they realized that their systems themselves are not ready, so that optional from April has been deferred. Now, I don't know compulsory from July whether it will stay or it will get deferred, but at some point of time it will come because somewhere at the back of their mind they want to do this. It's only that election pressures force them not to do it. And systems pressures do not permit them to be even more vocal. But at some point of time, I'm sure this is the direction the government is moving into. So let's look at a few minutes onto this. Current flow, we all know GSTR 1 and 3B is what we regularly do. Time mila, tabhi 2A or 3B match kar lete. So in software language, we say must have and good to have. Right? This is a lingo we always use. So you always say GSTR 1 and 3B is a must have. नहीं है, रेड मार्क आ जाएगा, 20 का 21 नहीं होना चाहिए. गलत जाएगा तो भी प्रॉब्लम नहीं है, लेकिन 20 को जाना चाहिए. So that one bucket list is ticked for the management for compliances. Now, GSTR 1 3B किया and 2A एक आध बार किया. सितंबर में किया क्योंकि सर ने बोला करना पड़ेगा. फिर अक्टूबर में गवर्नमेंट ने मार्च कर दिया. तो अभी कर रहे हैं लेकिन चिल्ला चिल्ला के कर रहे हैं. Why did they want to extend it to March? और एक बार पूरा exercise करना पड़ेगा. Right? Now, please understand that entire process of matching is coming in between. In the new proposed flow, GSTR 1 gets replaced by another document called ANX 1. They don't want to call it return because they got a lot of flack by saying there are 3 returns a month. So now they don't want to say it's a return. They want to say it's an annexure. So there's an annexure 1 which you will file around 11th. Similar to your GSTR 1, definitely. But there are small nuances which we'll go to a bit later. GSTR 3B ka replacement hai RET1, which is the only return. And if you are small entity, then there is something called as a Sahaj, there's something called as a Sugam. Nothing is Sahaj and nothing is Sugam in life. But then there are those good words which they want to throw to you. And so there are turnover limits, there are certain things which you can do, certain things which you cannot do. And then there's a complex grid which will tell you that in these cases you can go in Saral, these cases you can go in Search, and then balance cases you can go in your RET1. But I don't want to go into all of that, I'll only talk about RET1 today. So when you come to RET1, it's like your GSTR 3B. But an important thing is, between ANX1 and RET1, you have ANX2, which is nothing but your 2A and 2. So between 11th and 28th, month on month, you have to do the reconciliation. Otherwise, your bucket list will not get ticked. You will not be able to file returns, you will not be able to pay taxes. And that, according to me, is a big, big change. Because doing it in a week, I understand in many companies it's humanly impossible. And that's where your systems will have to really grow up. Your systems will have to match. Somewhere you will have to look at integration of ASPs with your ERPs. Somewhere you will have to move a little bit beyond Excel and see how you can handle this ANX2 piece within the 8-10 days which they give you to do that. Another important thing is, till date you must have seen they have extended GSTR 1 hundreds of times. How many times did they extend GSTR 3B? I think a couple of times. And that too a day or two. They will never extend 3B. Do you know why? Yes. GSTR 3B is linked with payment. Your RET1 is linked with payment. So RET1 will never get extended. And RET1 can happen after ANX2. So, अभी तक अपने को सितंबर मार्च को सब मिला, वो कितना मिलेगा बाद में वो नहीं मालूम. So that is the second. What I'm trying to say is, somewhere July 17, all of us, including me, were very enthusiastic, very excited about ensuring changes, ensuring the right practices. फिर धीरे धीरे एक एक करके provisions dilute होते गए. We also went to our businesses as usual. You are now with this proposed new written format. Perhaps we'll have to bring back that rigor or bring back that excitement, and we'll have to drive. And many of us maybe in tax departments, accounting departments, you might have an outsourced IT vendor. और तभी बहुत पीछे पड़े थे कि नहीं मुझे फॉर्मेट बराबर चाहिए, ये डेटा चाहिए, ASP चाहिए. फिर ASP तो कहाँ खो गया वो पता ही नहीं है. गवर्नमेंट ने एक ऑफलाइन यूटिलिटी दे दिया. Most of the ASPs are now out of business. Now, not even going into that, what I'm trying to highlight is all of these will now have to be सबको नींद में से जगाना पड़ेगा, which by itself will take some time. And therefore, it's important that we just don't put it aside as a side document. Now, what are some important changes? I think few important changes which come up is output RCM is to be declared by the recipient and not by the supplier. अभी तक क्या था, in your GSTR 1, let's say if I'm a registered transporter, I will declare output RCM and put a tag, and it will flow into the GSTR 2A as a liability of the recipient. Now I don't have to disclose the invoice. The invoice level data is to be disclosed by the recipient. Now this has an impact both for a supplier as well as a recipient. If you, and most of us are recipients of RCM services. GTA सब लोग पे करते हैं, लीगल सर्विसेज सब लोग पे करते हैं. अब तक क्या करते हैं हम लोग, 3B में एक फिगर डालते हैं. अभी क्या करना पड़ेगा, लीगल सर्विसेज में जितने बिल्स है वो बिल वाइज डिटेल, जीएसटी नंबर वाइज डिटेल, अगर जीएसटी नंबर नहीं है तो उसका पैन नंबर वाइज डिटेल अपलोड करना पड़ेगा ऑन 11th, नॉट ऑन 20th. सो अभी तक क्या था, 11th तक आपका सेल्स रजिस्टर फ्रीज होना था. योर एक्सपेंस रजिस्टर कैन बी ओपन अप टू 20th. नाउ because RCM has to be uploaded on 11th, your expense register has to be finalized before 11th, and it should have your GST number of the vendors, it should have your PAN number of the vendors if GST number is not available. So that is one important compliance change which will result in a lot of activity. Second important thing which they have done is they are saying amendments will be carried out in the original month itself. So for example, right now what is happening is if you have a transaction of July 17, if you amend it in March 19, it will appear in the GSTR 1 of March 19, GSTR 3B of March 19. Now this really results in a lot of topsy-turvy reconciliations. Now what they are doing is, they are saying, okay, if in July 17 there is an amendment, if you discover it in March 19, subject to its being in the time window for rectification, you will still amend the return of July 17 only. So each month there will be an amendment return. Just like you have RET1 and Annexure 1, there will be amendment returns for amending transactions of that month. And you can keep on amending multiple times. It's like a TDS story. TDS, if you put a wrong TDS number or a wrong PAN number, you can amend that quarter's return. And you can keep on amending it multiple times. That is the thought process now which is coming up instead of the new month where it is happening. So again, this is a process change which becomes important. The third and the most dangerous thing is Annexure 2, which is your equivalent to your GSTR 2A, becomes the starting point for claiming credit. You are allowed a self-claim, but your starting point is Annexure 2A. You will have to download your GSTR 2A, which is equivalent to Annexure 2 in the new scenario. Each transaction, you have to say accept, reject, or pending, like what we have discussed earlier, and then have self-claim of extra credits. Now, this results in a lot of control issues in larger organizations. Because today what happens is, आपके पास एक credit ledger books में. In that credit ledger, you have let's say a credit of 50 lakhs. So you claim 50 lakhs in 3B. साल के बाद में आपको 50 lakhs का total 6 crores हुआ. वो 6 crores को 2A के साथ मैच करते हो, वो outside the system करते हो, Excel में. Your books are sacrosanct. But now, you have 50 lakhs here. In 2A, you have 10 lakhs. And that's going to happen in the first few months. Your starting point is 10 lakhs. Now you have to decide whether the balance 40 lakhs, I want to self-claim or not claim. Because self-claim is with a risk of interest. So some companies will say, no, I don't want to claim. Let it come next month, then I will claim. So books में 50 lakhs का balance है. आपका credit ledger में 10 lakh है. आपको 40 lakhs, you will have to move from your accounting, or you will not be able to tally accounts and GST returns in any manner. So a lot of care will be required because your starting point is Annexure 2. And you will have to really set up systems and your accounting entries. Maybe you might need to create a few GST deferred accounts or GST suspense accounts to make sure that somewhere there's an alignment of balances between your GST returns and your books of accounts. All of this will need systems level changes to monitor and accounting level changes to control them also. Today, a simple thing like, expenses on which credit is not eligible. Motor car you buy. Most of the organizations will straight away put the motor car into the fixed asset and will not report anywhere. Now that also will have to come into the matching process in your Annexure 2. You will have to accept the transaction and then say that I am accepting the transaction, but I am ineligible for credit. Now, doing all of this will need some systems changes, because otherwise how will you know in your organization how much of rent-a-cab expenditure is incurred? Very difficult to identify all of that. So that is all going to take time. And the last part is, under the new regime, 6-digit HSN code is mandatory. So uniformly, wherever you are in 2-digit or 4-digit, please make sure that you end up with a 6-digit HSN code. So last couple of slides, and then maybe we'll wind up this marathon. Some do's and don'ts, because this will sort of summarize things which we have talked about till now, and a couple of new points. One is renewal of LUT wherever you have not done. Registration data ideally should be sacrosanct. Over a period of time, when you applied for registration in July 17, you might have defined your directors, authorized signatories, places of business. As time progresses, there might have been changes in that. If you have missed out something, just have a quick recheck. Some directors have changed, some authorized signatories you want to change. Suddenly you shouldn't end up with a fire that, okay, there is no person whose digital signature is valid today. You shouldn't end up in a scenario like that. So please make sure that your registration data is accurate. This we've talked many times, but I'll still talk. Each branch, each office should have your registration certificate and the GSTN displayed at a prominent location, and the GSTN has to be at the board also outside the office. Invoice credit note series, if you want, there's a lot of confusion on this. If you want to change, you can change. The only requirement is, in a financial year, you cannot have a duplicate invoice number. It doesn't say that you have to start again at 1. If you want to continue the same invoice series, you can. If you want to start a new invoice series, you can. Only requirement is, for a financial year, the same invoice number cannot get repeated twice. Self-invoices for RCM transactions, delivery challans, e-way bills. E-way bills is now becoming more and more important in terms of tracking of non-compliances. So if there are e-way bills which are not resulting in a supply, please take care of it. In many organizations, I understand e-way bills has been delegated to the SCMs or to the logistics teams. If that be the case, the tax teams are not even aware what's happening on e-way bills. Please, once in a while, look at it and make sure that your e-way bills and invoice data matches in the right manner. Reconciliation of books, we talked about those methods of reconciliation, all of that continues. Check if there were any credits which needed reversal. Branch transfer of services and a branch transfer document and an invoice to make sure that the service invoice is created internally. Fixed assets, a whole set of things which we talked about, including the fact that you can't claim both credits as well as depreciation. And then, of course, reversal of credits and reversal of credit on sale or disposal. If there are any credit notes or amendments relating to financial year 17-18, March 19 is the last moment at which you can do it. So this return therefore becomes very, very important. The input tax credit claim for 17-18 and its reversal, 6-digit HSN code we talked about. The law now permits digital signature on invoices, and an invoice which is not signed is now a valid invoice. So you might like to adapt your systems accordingly. And the last but not the least is, if you are a multinational company, most of the times at the end of the year, you will create a provision for expenses, specifically cross charges of your parent company. And there is an entry which is passed which says that, okay, some IT cross charge or legal cross charge or some brand royalty payments. And it's just a provisional entry, and actual amounts will always be determined later. Now the problem here is, in the time of supply rules, transactions with associated enterprises in the nature of import of services trigger a tax liability moment that entry is passed in the books of accounts. So if you're passing an entry on 31st of March for associated enterprises, it will immediately trigger a tax liability, irrespective of the fact whether the amounts is tentative, actual, all of that really does not matter. Moment there's an entry, you'll have to end up paying up a GST on that transaction. So that is one more thing which you need to be a little bit careful about. So these were, I think, a few things which I thought were important for all of us to understand. Since around 6 months had passed on, I thought we should meet once in a few months and just have a regrouping of those points, and then maybe go home and try to see what all things we can implement. I know some of these may not be easily implementable, and then necessarily whenever it comes up, we might need to end up paying interests or penalties on those accounts. But more compliant we are, the better it is. So thank you very much for hearing me on this good and simple tax, which every day we try to make more and more simpler. Thank you.
Thank you, sir. We have covered a lot of topics in relating to GST, actions, plans, takeaways for all of you, what you need to do before year-end closing. And I'm sure a formal load of things would be in order. I request all of you to please carry it out with a great round of applause. Thank you. The important job that I was asked to do is, apart from giving the round of applause, and is to introduce to you our team. As you know, we are a CA firm and we have regularly people changing, but you keep on dealing with our team. So it's necessary that you have a face to each name, because otherwise most of the times people just interact with you on phone or via email. First, we have the leadership team led by Sunil sir, Yash, me, and we have an addition this year. Darshan Ranawat has been elevated to a partnership level. Welcome, Darshan. Next, we have the team of senior managers, Prakash sir, Khyati, and Aman Haria. Aman has been elevated as a senior manager this year onwards. Please. Then we have a team of our own set of team of managers and assistant managers. Rishabh, Siddesh, Shalin, Dhaval, Darshik. Yeah, sorry. Rishabh, Siddesh, Darshik, Dhaval, Dipti, Himanshu, Ronak, and Nikita. This is our core team comprising of chartered accountants and advocates. Next, we have a support team including Charmi, Monique, Vrinda, Ushmi, Yashvi, Sonanki, Palak, Parthav, Rishabh, and Riddhi, and Chandrakant. A lot of faces here would not be available because of exam season, but these are the people who help you in filing your GSTR 1 and 3B on time on a monthly basis. They keep on harassing you for OTPs and all. So this is our team. Thank you very much. It has been a pleasure to have you all again here, and we look forward to have you all again soon as and when some new updates come in the law. Thank you very much.